that will effectively end open elections. Elon Musk's SpaceX has successfully put another 60 Starlink satellites into orbit. A Falcon 9 rocket was launched early today from the Kennedy Space Center in Florida. Starlink is Musk's space-based internet service that has more than 1,100 satellites orbiting the Earth. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Expect that face-to-face learning is the ideal, but I don't think that we are ever going quite back to that. What we're seeing is more of this integration of the technology into the day-to-day. We have seen that schools have had this kind of trial by fire in terms of trying to reopen successfully, and that many schools have had to use a system of using different ideas around what it would take to reopen and then pivoting when those ideas did not work well, meaning that some have had to go back and had to close. And that's been a global challenge.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
The economy is coming back. People are getting vaccine. We're on the way out of this. We're about to have a boom. And if we do have a boom, it will have absolutely nothing to do with this $1.9 trillion.
Just a lot of stuff in there that begs the question about what were they thinking. But it was a liberal wish list. They've described it as the most progressive domestic legislation in a generation. It certainly lived up to that billing.
I think one thing the Biden administration really has to focus on is the risk of what all this debt's going to do to us. Republican backlash to the passing of the $1.9 trillion stimulus bill. Minority Leader Mitch McConnell, Senator John Thune of South Dakota, and Senator Rick Scott of Florida. Tom Keene, this is the story right now, how the Democrats sell this plan and how the Republicans push back going into next year.
Well, the American economy is 70% consumption, and there's a huge belief here that the multiplier, John, as you mentioned correctly yesterday, is really going to be something. We're going to see a huge consumption oomph.
Look at the markets this morning. The boom's coming, and apparently it has nothing to do with this $1.9 trillion plan. In your equity market, we're up 30 points on the S&P. We advanced 0.75%. On the Nasdaq 100, we're up by 1.9%, off the highs of the session so far. And in the bond market, just about sub 150 on 10s is probably a headline. 149.71 on a 10-year yield. We come in 2 basis points. In the FX market, dollar weaker, kicking off things on Monday with some immense dollar strength, particularly against EM. We've unwound a lot of that in the last several days. Euro dollar back to 119.66 as we count you down to an ECB rate decision in about 1 hour and 25 minutes and a news conference 45 minutes after that.
Yeah, 2 things, John. EM is not there yet. It's not through technical resistance, but it's come back very nicely. I look at ADXY for that, but there's a lot of other good indices, including CSI in China. I'd also note the VIX with a 22.08 is really shaping up nicely. Shaping up with the rest is Jack Fitzpatrick. He will be collecting pens as the president does a signing ceremony on $1.9 trillion. Jack, I want to ask the question that's not being asked. What happens after the checks are cashed? What is like the next traumatic oomph of this bill? I mean, what happens 3 months from now, 6 months from now?
Quite a bit. You know, the immediate checks are a chunk of the bill, but it's not the whole thing. The increased child tax credit is a significant part of this that takes it from $2,000 to $3,000 or even $3,600 for young children. That Democrats are that may be the thing that Democrats are most excited about. The money that goes to states and localities, $350 billion, takes a while to move through the system and actually get into the economy. So, you know, most of the bill has somewhat of a delayed effect, and that's why you hear these Republican criticisms that this isn't just emergency spending for the coronavirus. Much of the money that filters into the economy is going to do it later this year or even in the out years.
Jack, it is so important that you're on this show today because the confluence of economics and politics have never been more intertwined. I was struck by a story this morning on the Bloomberg. Republicans try out inflation as a stick to beat Biden's stimulus. The idea that inflation, one of the most controversial aspects in markets, is also one of the most controversial aspects in Washington, D.C. Can you talk about how different politicians are lining up on either sides and the economists behind their views?
Yeah, it's been very, very partisan in Washington. We've heard from Republicans over and over again, there is this risk of inflation. From Democrats, we've heard them pointing back to the post-2008 recovery, saying we didn't do enough then, we're not going to make that mistake now. It has gotten into really just sort of a philosophical debate about what the legacy of this bill will be. There's a House member, Guy Reschenthaler, Republican from Pennsylvania, who said a couple days ago his biggest concern about this bill is that it will get credit for the economic recovery to come, and it will play into, he said, a Keynesian popular debate in Washington and push that worldview. So inflation has been a very partisan talking point that has been the Republican point the last few weeks at least.
Jack, what's gaining traction with the public? The idea of higher deficits, the idea of higher inflation, or the idea of pork? I mean, which Republican talking point really is the one that will have the sticking power?
None yet. I mean, this is still, according to every poll that's come out, a very popular bill outside of Washington. The pork issue may be more of an issue because they're actually about to start earmarks on this infrastructure bill that's coming up and on regular spending bills. So there will be plenty of Republican talking points going forward. We'll see if Republicans actually participate and submit earmark requests. But the inflation talking point has not caught on, and you see polls showing a majority or close to a majority of Republicans supporting the bill. So this, at least in the popular conversations around the country is a battle that Republicans haven't won, at least not yet.
Jack, Republicans can control the trajectory of this recovery. They can control the timing of it. The Republican governors can reopen early, and we've seen that in places like Texas and elsewhere. Jack, do you expect to see more of that?
Yeah, there's no sign of change in terms of the polarization among governors in the country. Maybe one difference is that the governors, or at least many of the Republican mayors, did want this money from the federal government in the bill, while Republican lawmakers said that it wasn't necessary, at least in many cases, for states and localities. But that is the big difference, and you're right that that can have a huge economic difference in terms of reopening. And that's somewhere where Biden saying he'll work with states hasn't really made a difference. He hasn't persuaded Republican governors to slow down or maintain mask mandates, and it's somewhere where he has not taken a harder stance and forced their hand at all.
Jack, what is the process of committing infrastructure on Capitol Hill? Do we know, is it such a foreign success that nobody really knows the process that's out ahead the coming months?
They've talked about it so much that, and started to work on it so much in recent years, it seems like they know what they're doing.
You think so?
It is going to be politically difficult, though. There have been talks for years about the bipartisan appeal of infrastructure, but they haven't really gotten into...
Okay, so you go, come on, you give Mitch McConnell a new arena in Louisville or whatever, you know, I mean, Louisville can't beat Duke, but, you know, you give Senator McConnell something and the bill gets done. That's the way it works, right?
That is sort of their goal. That's why they're starting, one of the reasons why they're starting this earmark process. That, though, can't be done through the partisan reconciliation process, which means they do have to actually get bipartisan support. The question also is, how do you pay for it? Do you include the Democratic tax measures to raise taxes on corporations in it, which then obviously would turn off Republican support? So that's where the process in Congress makes it much more difficult than it seems.
Jack, great to catch up. Good to see you. Jack Fitzpatrick down in Washington, D.C. of Bloomberg Government. Tom, what an issue we've got on our hands right now. Already a battle to sell this plan. $1.9 trillion of it is all going to pass. It's done. It's passed Congress. It'll get signed tomorrow by the president. And the president believes that 2 presidents ago, President Barack Obama didn't do enough to sell his plan coming out of the last financial crisis, Tom, and he's going to really push this one hard.
It's been a nation of gridlock. Gridlock is over. That's all it is. And it's about, as you mentioned, John, I think 3 days ago, it's all about that historic election or elections in Georgia.
From New York City this morning, good morning. Alongside Tom Keene, Lisa Bravis, I'm Jonathan Ferro. Equity futures rallying up 0.7% on the S&P, on a NASDAQ up by 1.8. Your bond market, well behaved, yields in 2 basis points to 149.88.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From New York City for our audience worldwide, live on Bloomberg Television, this is Bloomberg Surveillance, and here's the pop in the equity market. It's in the NASDAQ, up by 1.8% on a session so far. On the S&P 500, up by 0.7%, a 10-year sub 150 this morning, offering support to growth equities maybe. Switch up the board, here's the story for the ECB. Over the last month, here's your move on a 10-year in the United States, up by about 34 basis points, justified by a better outlook. That is inconsistent with what we're seeing in Europe in the minds of the people on the European Central Bank. So a yield on a 10-year in Italy up by 20 basis points over the last month. No big drama, but they worry about this, the direction of travel. If things get better in America and Treasury yields carry on drifting higher and you get that contagion effect into Europe and yields go higher there, without the corresponding pickup in the outlook, Europe has a problem, and Europe has a bigger problem with the vaccine rollout right now, as you all know. Let's finish on this one, on euro dollar. Started January 123 handle. We were talking about 125, 130 maybe. Tom Keene, the one thing going for President Lagarde today is this one is sub 120.
I looked at the regression, John, back to the beginning of the financial crisis, and it's just been long-term weaker euro. Yes, a little bit of a pop-up here recently, but you really wonder if it reverts back to some form of ever weaker euro. Maybe not a big deal, but there it is, this impulse over 10 years of a weaker euro.
Tom, you've got to think about a cycle, and one thing that Europe failed to do in the last cycle was engineer a recovery that actually led to higher interest rates. Are they going to fail at that this time around again? And that's largely going to be out of Christine Lagarde's hands. That comes down to fiscal policy.
It comes down to fiscal policy and also productivity. Briefing us this morning, Ian Shepherdson with Pantheon. Wonderful work on Europe. Their wonderful China note as well, but we focus on the European Union with Dr. Shepherdson. Ian, I look at what's going on, and as John mentions, it's about a cycle. Can Europe get to a normal economy, or is it forever strapped with a malaise?
Well, it's got some really big, really deep structural problems, which extend back even before the birth of the euro. But the euro jamming all these disparate countries into a single currency certainly has made things worse. And of course, as we all know, we talked many times about the lack of coordination between fiscal and monetary policy and the lack of aggression of fiscal policy compared to, say, the US, especially the US. And even the UK. So these things won't be fixed by a faster vaccine rollout by the end of the COVID pandemic. Right. Europe will still be stuck with these structural difficulties.
I noticed sterling today getting up near a 140 again. Give us the Shepherdson initial take on Brexit, and not what Brexit means for Prime Minister Johnson, but what does Brexit mean for Brussels?
Well, it's a problem for both the UK and the Eurozone. It's made both parties worse off. I mean, pulling out of a very deep, very long-standing, very effective trading relationship and going back to something much more primitive makes both sides worse off. Of course, right now, this effect is kind of being sidelined in the eye of the public in both the UK and in the Eurozone by the COVID crisis. But stepping back from the COVID, in the post-COVID world, both parties to this trade are worse off. And that's going to be a permanent hit. You can see it in the incredible confusion in the UK business sector of the difficulty now of exporting and importing to and from Europe. And of course, the counterparties in Europe are seeing the same thing. So bottom line is the trading activity, which otherwise would have taken place at the margin, now doesn't take place. That's a loss to everybody. It's a permanent loss. And I'd like to think that in some future time, it will eventually lead the UK to see some sense and to rejoin the Eurozone. that's not next year's trade.
Well, but in the meantime, just sticking with this idea of the fact that we're very much in the COVID era, and particularly in the European Union, which has been pretty slow to vaccinate, there's a question about whether the ECB is bringing an eyedropper to a flood, the idea that they're trying to maneuver around a bond market at a time when the European Union continues to talk about delays to the coronavirus vaccine rollout. Just now, the European Union warning the governments about the risk of further AstraZeneca vaccine delays. How much does this affect your longer-term outlook for the Euro region's growth prospects, and how much is it changing in real time?
Well, the key thing is that the longer you're in the COVID hole, the bigger is the risk of longer-term scarring in the labor market, longer-term scarring to corporate and personal behavior, and therefore longer-term scarring to productivity growth, which is really what we all care about in the long run. We get obsessed with these short-term data, but really, what matters in the long term is productivity growth. And the longer that the fiscal response is on the smaller side of where it should be, and the longer the monetary response is the same, and I'd like the ECB to do more, then the deeper and more longer lasting will be that scarring. And so Europe is kind of already in a structural difficult spot, but it does run the risk that it makes it worse. And of course, for markets, this is just being highlighted pretty much every day when we're looking at these amazing vaccination numbers from the UK and the US, and we're looking at a very aggressive fiscal response from those countries. Of course, the US just passing the $1.9 trillion bill yesterday. And we're looking at Europe and saying that they're kind of putting themselves in a position to fall further behind and to dig that structural hole even deeper, which is not to say that come the spring or the summer, Europe, won't have a strong rebound. It will. There's a huge pile of consumer savings and businesses are quite keen to invest. But at the margin, they're making things more difficult for themselves in the future by not being more aggressive now.
So, Ian, let's get a forecast. If you had to make a call right now, a cycle call, do you think they can engineer a recovery that actually leads to a higher policy rate?
Not within the next 2 or 3 years, no. I think that the US and the UK will be raising rates years plural before the ECB can.
What do you think the ECB can actually do, and do you think it's largely out of their control?
Well, I mean, they can always do more. They have effectively an infinite armory to deploy. The PEP is 1.85 trillion in total. There's still some people think they won't use all of it. I think that they will. They could expand it. I'd like them to, though I don't think that they will. And of course, we're still looking at a fiscal response which is inadequate compared to some other countries. So the thing is that monetary and fiscal policy are not interchangeable. They are complementary. They work together, but you can't swap more of one for less of the other. And so the ECB, although it in theory can expand its balance sheet infinitely, that doesn't have the same effect. It doesn't permeate into the real economy in the same way that fiscal policy does. And that's where the US in particular, I think, has been so much more aggressive. I mean, it might prove with the benefit of hindsight that the US is now being too aggressive, but that's another question for another day. Right now, I'd like to see the Eurozone doing much more.
I'm struck, Ian, by you saying that the European region will be years behind the U.S. when it comes to raising rates. How then are people seeing a weaker dollar? I'm struggling to understand how the euro then continues to strengthen versus the dollar, which a lot of people are saying if A, the ECB keeps rates lower than the U.S. for a very long time, and B, growth remains very much below where the U.S. growth is. I mean, this just isn't working together.
Yeah, you just hit the nail on the head, really. I mean, I'm very much expecting a stronger dollar to emerge over the course of the next year. I mean, the broad trade-weighted dollar is already up off the lows that we saw at the end of last year, but I think it could rally really quite aggressively as we get through the spring and summer, because I'm pretty convinced that the US is going to see a gigantic rebound, especially in consumption, but also in business spending and hiring and all those other indicators that markets follow. And the Eurozone is going to be left in the dust for some time because the vaccination rollout is so slow and it's going to take much longer to get rid of COVID. So on the back of that, you would expect the dollar to be rallying quite hard. And I got to say, if you ask me where it's going to be relative to the euro in a year's time, I would say 5 to 10% higher. I just don't buy this idea that the dollar really can't rally aggressively against the euro. I think it can in the right circumstances.
Ian, the U.S. needs a gigantic rebound like Newcastle. Give me a statistic. What's your GDP surprise for the U.S.?
I think it's to the upside. I mean,
come on! You sound like an economist, Ian. Give me a number. We need a number on a Thursday.
I think the U.S. is going to grow. it's going to grow 6 or 7% this year, and I think probably grow 4 to 5% next year. It'll close the output gap completely. The unemployment rate will be back down to 3.5% by the middle of next year, and the Fed will be hiking by the end of next year.
And John, what is so important there is a 24-month reach of 6% and 4%. You do a blended 2-year 5%. That's on the edge of China.
3.5% the middle of next year on unemployment, Tom. Ian, let's wrap up there. This is a challenge to the Fed's forecast, not their reaction function. You just think they'll meet their mandate, their objectives quicker than they think they will?
Yeah, I think they will, and I think that it'll be a great thing to see inflation back above 2%. But it will, of course, ultimately cause them to have to revise their forecast. You know, the dot plot is not gospel. It's not carved in stone. It's what they think based on current information. And my guess is that the incoming information over the next 6 to 12 months will be significantly stronger than they think on both growth and inflation, and the dots, therefore, will have to move.
Ian, great to catch up. As always, a single point above relegation. Newcastle United fan Ian Shepherdson there, Pantheon Macroeconomics Chief Economist. At least we didn't talk about it, Ian. We're letting you go. 3.5% unemployment, Tom, by the middle of next year, and a Fed that he thinks will have to move shortly thereafter, closing the output gap very quickly as well. And this is the story. It's about the Federal Reserve and its forecast. It's not about the reaction function. It's just the belief out there among some economists, Tom, that the Fed reaches its objectives quicker than the Fed thinks it will.
And something about America as well. I think we forget, John, the size and complexity of the American economy. Lisa mentioned this the other day, the parsing of service sector versus goods producing. And that service sector economy, the restaurants, all that we know, it all comes on. And that number you're touting gets you to claims of, say, 300,000. No one's modeling that right now.
Well, I hope it's lower than that, Tom.
Yeah, absolutely. I'm hedging it, John.
We are talking about a boom. We are talking about a boom here, Tom. We've got really sensible conservative economists talking about GDP this year of 6-7%.
Yeah, Kit Jukes mentioned that today, that Societe Generale in their new general outlook talks about an unprecedented boom in America.
And how does this market react, and how do perceptions of policy adapt, Lisa, in the next several months when that data starts to come through?
Well, there's a question, too, about Jay Powell as a politician versus Jay Powell as an economist. And he has operated very politically. And there's a question of what the upside is for him to acknowledge the boom that economists on Wall Street keep talking about, right? Because if he talks about that, then why isn't he giving a more flexible outlook to when they could raise rates, John?
Boom on the NASDAQ this morning, up 240, Tom. We advanced around about 1.9% for big tech.
Yeah, well, but critically, John, it's across the board. What we're beginning to see, and one day it's this and one day it's that, is a general lift in equities. Right now, yeah, NASDAQ leads the way. But I would note, I'm sorry, John, Standard & Poor's, I'm on the 4,000 watch.
There we go, up by 27, 39.14 on the S&P 500, up 0.7%. Your 10-year, just sub 150 at 1.499, and down 2 basis points. We head to Europe shortly. An ECB rate decision just around the corner, about an hour and 5 minutes from now. The ECB has a vaccine problem. Up next, Jason Farley, Johns Hopkins University nursing professor. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. President Biden is preparing a nationwide victory lap to promote that $1.9 trillion coronavirus relief plan. He'll hold a ceremony tomorrow to sign the measure into law. Then there will be a series of appearances across the nation to ensure voters know that he and fellow Democrats are getting the credit. The bill provides a $1,400 direct payment to millions of Americans. There's also billions in aid to state and local governments. The U.S. and China are disagreeing over how to describe a key meeting next week. Secretary of State Antony Blinken and National Security Advisor Jake Sullivan will meet with their Chinese counterparts in Alaska. Blinken says the meeting is not a strategic dialogue, a reference to regular talks that fell apart under Donald Trump. But Beijing says it is. Both sides are under domestic pressure to avoid looking weak. The European Union is urging the UK to come clean about its export of coronavirus vaccines. The bloc has accused Britain of having an export ban. Prime Minister Boris Johnson denies that, saying that he, quote, opposes vaccine nationalism in all forms. And the emergence of coronavirus vaccines failed to bring more students back to U.S. college campuses. They report that enrollment fell by 4.5% for the spring term. That included a 16% decline in international students and a 9.5% drop at community colleges. And And Warren Buffett, well, just joined one of the world's most exclusive clubs. According to the Bloomberg Billionaires Index, he has become the 6th person to have a fortune of at least $100 billion. That's source of almost all Buffett's wealth is his company, Berkshire Hathaway. Shares are up some 15% this year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
90% of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds for the global economic recovery.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
If we have a surplus, we're going to share it with the rest of the world. We've already decided we're going to work with the outfit COVAX. We've committed $4 billion to help get the funding for more vaccines around the world.
President Biden there doubling the order of J&J's one-shot COVID-19 vaccine from New York City this morning. Good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Here's the price action this Thursday morning. We're set up as follows. Equities rallying. The Nasdaq up by 1.8%. The S&P up by 0.7%. Yields lower. There is a bid into the bond market. Treasuries 149.53 on 10, sub 150. And a euro firmer going into that rate decision, Tom, in about an hour from now. Euro dollar $119.65 and up about a third of 1%.
That is a Euro show. Lisa, John, and I preparing for this with our great team. Well, you know what? The information changes, folks, and news flow changes, and we change as well. Jason Farley of Johns Hopkins scheduled to be with us here on a pandemic update, the good news of America. And Dr. Farley and the rest of us shocked by what we see out of Denmark on AstraZeneca, what we see out of the EU on blood clots. Jason Farley with a wonderful research at JHU, and I really go to Robert Brodsky in hematology as well. Give us a summary of the risk right now in America to the thrombosis, the embolism risks that we see out of Denmark.
Sure. Well, good morning. We've known that COVID-19 causes a state of hypercoagulability or blood clots, as you say, since the beginning of the epidemic. We've talked about things, many types of things, early MI, including cerebrovascular accidents in patients or stroke in patients with COVID-19. We've seen COVID toe, which is little blood clots that block the blood flow to the vasculature. So we know that this causes a state of the body's response leading to lots of blood clot formation. This has caused significant disease in the elderly, particularly, and those with coexisting comorbidities in the United States as well.
We look, and I mentioned Francis Collins of NIH earlier with the key phrase, even in younger people. What is the risk of these hematology events to younger people if they get COVID, which they heal from easily, but nevertheless they've got blood clot risk?
Well, certainly. So anything that ups the body's response to infection, particularly the inflammatory responses, can trigger the clotting cascade. And we do see it lower risk in younger individuals with fewer comorbidities, and that risk rises both with age as well as underlying disease state. So what we know is that we have seen cases of blood clots in younger individuals, although they remain relatively rare. Tom?
Professor, can we talk about the vaccine rollout and just add to this conversation? Europe has a problem right now on the continent, and I don't want to get into the analysis of what has happened in Denmark, but the outcome is pretty clear. The consequences are clear for the continent. There is an issue with vaccine acceptance now and trust in some of these vaccines. Professor, have you seen us bump up against that issue yet in America?
Sure. So vaccine hesitancy or problems with vaccine acceptance has been a problem since the beginning of the pandemic. But we've seen that muted, however, because of lack of vaccine supply. So importantly, right now, queues are really long for COVID-19 vaccine, and people can't find a vaccine even when they qualify. So importantly, we've seen this response of people not wanting the vaccine or people hesitant to get the vaccine, or a wait and see approach has been muted because of the supply issue.
And Professor, I think this raises the next question, which is when do we start to bump up against the acceptance issue, and when does that force us to actually get rid of the age caps on who can and who can't have the vaccine and just make it available to everyone? Do you think we're close to that point or not at all?
Well, certainly this has been a state-by-state response in who the categories are qualified to vaccinate in the United States. And quite frankly, there are many individuals who are still in the wings waiting, who are the waiting and hopeful to receive the vaccine. So removing age restrictions, I think, needs to bump up against us pushing into that 80+% of those 65 years of age and older. And in the United States, we're sitting at around 60% of those in that category. So I think that we need to continue to focus on our age categories for the short run, probably end of March, beginning of April, depending on the number of shots that we get out into arms, but then begin to think about the expansion of those categories and getting the next round of people with shots in their arms.
Jason, in the meantime, John's talked about this a lot, the idea that a number of governors are taking matters into their own hands, as you said, it's state by state, and they're reopening perhaps earlier than health officials would recommend. What do you say to people who push back against health officials' assertions and say there hasn't been enough done to recognize the depression, the suicides, the violence that you have seen break out that has had real medical impact that has stemmed from some of the shutdowns that continue to be ongoing?
Well, certainly. And as a nurse, we're trained to really think about the consequences of disease, like the ones you're mentioning. So the fallout of disease, if you will. I would also add to that the consequences of COVID-19 remain real. And we are seeing lots of positive numbers with increased vaccination, increased amounts of herd immunity, if you will. Estimates coming out this morning from the New York Times of 40% across the United States. That's all good news. We also are also seeing lots of say to them that the CDC just came out with some amazing data on a county by county level as of earlier this week, demonstrating that the earlier you roll back masks, the sooner you repopulate restaurants, the more likely you are to see a greater number of cases resurge. And so we have to further push herd immunity. We have to get more shots in arms before we begin making this, not because we don't understand and recognize the consequences of these diseases, but most importantly, we have to get ahead of the variants.
Professor, good to see you. As always, Jason Farley there, Johns Hopkins nursing professor on reopening and the risk of increasing infections. And Tom, here's an issue right now, and it's not about reopening and increasing infections. Over in Germany, there has been a plan to gradually reopen, but the cases are going the wrong way. They're going the wrong way in Europe, and the vaccinations are going in the wrong direction as well.
And for our American audience on radio and TV, I really can't convey this. When you look, John, at the data, whether it's Johns Hopkins or the FT or with the great work Bloomberg's doing here, the disparity and the geography, not all of Europe, but certain places, Milan, Germany, as you mentioned, it's just appalling. It's never been like this since last March.
And just to give you some numbers so people can get their hands around it, the pace of the vaccinations in Europe is just not picking up quickly enough to close the gap with what's happened in the UK or in the United States. 6.7% of the population in Germany has had at least one shot, 3.1% fully vaccinated. Just compare that to America, which of course had a head start, 9.9% fully vaccinated, 18.8% have had at least one shot, Tom. And that's the divergence, the spread between Europe and the United States right now. And it's that spread also beyond the bond market and the economy. The President Lagarde has got to grapple with as well.
And she's got to mention that. And also we got to see the number of vaccines that continue to come on. The answer is America organized, Europe less so.
Coming up, Peter Oppenheimer, Goldman Sachs Chief Global Equity Strategist on equity investments in Europe too. Your NASDAQ in the United States flying today, up by 1.8% on the NASDAQ 100. We're looking good. From New York City this morning, good morning. This is Bloomberg.
I have asked the Securities and Futures Commission and the Hong Kong EX to work together to explore the viability of our own Hong Kong version of specs. We remain very confident on the competitiveness of the Hong Kong stock market.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
There's a huge bounce that's coming as we normalize.
The propensity of consumers to spend is very high.
This is just a pause on what should be a broader cycle of dollar weakness as we get to the sweet spot.
Inflation is going to be a burst coming in the next 12 months, and then it's going to calm back down again.
Fed policy inevitably at some point is going to shift.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
An ECB rate decision 45 minutes away from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio. I'm alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Looking at your market right now, we are flying on the NASDAQ, up by 1.6%, up by around about 0.6% on the S&P 500. Tom, President Lagarde, a couple of hours away.
Well, the ECB really front and center, but John, I want to talk about what is not happening this morning and important for global Wall Street. Yesterday, we got a whole bunch of corporate announcements that were very worthy for the stock market to move higher. We don't have that today. Can you imagine what this tape will do if we start to get, again, constructive resets by America's big companies?
The companies are confident for a reason, Tom, a big reason, because we're talking about higher GDP growth this year and next, and much higher, 7%, I believe a 7 handle now over at Morgan Stanley for 2021 GDP.
And John, I know Lisa in the last hour was talking about inflation dynamics. To me, the blunt instrument of economic growth overwhelms that. I'm really watching those dynamics. Ian Shepherdson last hour came in a little quieter, 5-6%. A lot of other people aren't at 5 or 6%. They're higher.
As this year grows older, Lisa, this data gets a whole lot more interesting.
And also what's interesting is that the bond market is looking at their data now, and stocks are looking at the data that will be. They're basically predicting it out. So when we get some sort of inflation forecast that comes in below expectations now, the bond market reacts. And frankly, that just gives a further boost to stocks that are looking to the future, John.
Sub 150 on 10s. Here's your price action this Thursday morning. Good morning to you all as we count you down to an ECB rate decision. We look like this in the equity market. Equity futures on the NASDAQ off session highs, up about 1.6%. On the S&P, up 24 points. We advanced 0.6%. And there's the move in the bond market. Sub 150 on 10s, down 2 basis points to 1.4988%. And with Christine Lagarde, the ECB president, just around the corner, a stronger euro, Lisa. Euro dollar, 119.60.
Yeah, the idea here that possibly an easier monetary support from the ECB will actually be supportive of the euro, trying to wrap my head around that logic because it has been the opposite for so long. All right, that 7:45 rate decision is what we're watching, but even more so, that 8:30 press conference with Christine Lagarde, unwarranted tightening of financial conditions. That is the phrase that people are looking for to determine whether the ECB will come out and try to give whatever it takes in order to control the pace and frankly even the direction of some of the yields that have been going up. Then at 8:30 a.m. we get those U.S. initial jobless claims. This just shows the incredible ongoing pain, 725,000 initial jobless claims, as John was talking about. However, what I find interesting from a market perspective is that people have stopped caring unless there is a massive unexpected move, either up or down, in this data, despite the fact that we still have so much pain. People are looking to a future that is brighter.
Can I get some auction talk?
At least, yes. Well, we're going to get to the auction talk. So that's 1 p.m. 30-year treasuries, $24 billion of them will be sold. Yesterday's 10-year auction was lackluster, but at least it wasn't terrible, and so that's a good thing. But 30-year will be more challenging considering that disagreement that we have in markets and politically, as we were talking about last hour, when it comes to inflation, John.
American Airlines did all right yesterday with that issue, didn't they, in the last 24 hours?
That's an understatement.
A $10 billion bond and loan offering, Tom, and the yield on the 5-year tranche came in at about 5.5%. And that's junk debt. That's rock bottom. That's an airline.
Nice bond talk. Very traunchy of you, John. I bought the Austrian in December. I'm down 22% on the 100-year Austrian piece. Thank you.
Look out for the issuance on the corporate side today as well. Verizon in big with investment-grade debt at the same time as the Treasury comes in big with 30-year maturities. A lot to discuss.
I thought it was like Adidas. We're calling Verizon.
Verizon.
Seriously?
We're not doing that this morning.
Nobody
Peter
does that.
Oppenheimer, Goldman Sachs Chief Global Equity Strategist, wondering what he's walked into. Peter, good to see you. Let's start with Europe, shall we? Is the continent investable right now? Can you invest in Europe, given what's happening with this vaccine rollout?
In the equity market, you mean?
Yeah.
Yeah, absolutely. I think so. The vaccine rollout outside of the UK and the rest of Europe, of course, has been disappointing. And the recovery we're likely to see there is going to come later than you're likely to see in the UK and the US. But it's a recovery that nonetheless we think, will be very strong. And, we're above consensus in our growth forecast globally, particularly in the US, but Europe as well. We're looking at around 5% GDP growth for this year. And we do think the vaccine rollout will accelerate. But the important thing about the stock market is to recognize that it's not really as levered into the European economy as many people think. It has the highest beta to global world trade growth and global nominal GDP of all the major regions. So it's very operationally levered to the strong economic recovery that you were talking about earlier. And I think it stands to benefit from that, bearing in mind that it also has a high weighting in value areas of the market, which have lagged behind over the last decade, but are starting to recover.
Peter, what I think is so important here, and we've had the great joy of speaking with your colleagues, David Costin and Abby Joseph Cohen, and now Peter Oppenheimer, is it's all founded on Jan Hatzius's GDP call. How are the three of you linking in the global and Western world optimism of Jan Hatzius and the economic team?
Well, we all sit and work together, so we have a very coordinated view, and it does stem from that. We've consistently had a view for this year and next year that growth will recover more than the consensus is expected. The consensus is picking up now, but the vaccine program is accelerating very rapidly. There's very high degrees of household savings, which should support a strong rebound when it comes through. And of course, when we're looking at the equity markets, we're looking at the operational leverage to that growth. Globally, we're looking at least 35% profit growth this year. In some regions, like Europe, well above that, above 40%. And so it's really stems from this strong recovery that we're expecting. But bear in mind, it's not just the growth recovery. We're talking about an environment where policy rates are zero, real rates are negative, fiscal policy is expanding, commodity prices are going up, yield curves are steepening. That's a combination of factors that we simply haven't seen, at least over the last decade. And it's positive for risk assets, and it's also positive for areas that have lagged behind, like cyclicals and value stocks, which have further to run, I think.
Peter, the scenario that you're talking about has an inherent tension, and this tension is being played out every single day in markets, where you have bonds pricing in the now and the bleakness of the now, and you have stocks pricing in the optimism of the future. And that tension is that if bond markets start to price in the same optimism that stocks are looking at, the stocks can't rally as much as they are currently, at least if you look at some of the predictions with the NASDAQ and some of the expectations with the rate sensitivity. How do you sort of reconcile this incredible and growing tension?
Well, look, I think there's a couple of important points here. We've gone through what we would describe as the hope phase of the cycle. Usually starts during a recession when profits are still falling, and investors start to begin to get more positive on the future you get a big rise in equities led by rising valuations. We've had that, and we would expect equities to rise at a much slower rate as the actual growth comes through, and bond yields also adjust a bit higher. But bear in mind, equities can absorb quite a bit higher bond yields, certainly in nominal terms, given that the risk premia are historically high. I mean, you think about it, we've got, a very high technology stocks, and some people are worrying about a bubble. But bear in mind, back in the late 1990s, people were so optimistic about equities in the S&P, they were buying at a dividend yield of 1%, when the risk-free rate, the 10-year yield, was about 6.5%. Now we have a situation which is remarkably different. So we could see higher bond yields as long as it's reflective of higher growth, and equities could still do okay.
Peter, that's the key. Is it consistent with the outlook? So let's talk about that. Rates are the epicenter of everything. In the United States, the banks on the S&P 500 up by 23%. If the rate rise in Europe that we're seeing on the periphery in the bond market over the last month, in the ECB's words, is inconsistent with the outlook, what is the bank sector in Europe doing, up 18% year to date?
Well, I think, again, the bank sector is really at the epicenter of the value trade. It's been one of the worst performing sectors over the last decade. It's the most geared to a steeper yield curve and rising interest rates, and of course to stronger growth. And the banks have finally much stronger balance sheets. They're not issuing new equity. And also the ECB is becoming a little bit more lenient about the prospects of paying dividends or buying back shares. So we have to recognize that these companies are very levered and geared to the shift upwards in bond yields and also in growth expectations. And they were extremely cheap, having underperformed for a very long time. So we've been overweight at the banks over the last few months. And, I think that they have further to go, consistent with the kind of growth outlook that we've been discussing.
It is a trade that has delivered so far. Peter, it's great to catch up. It's good to see you. Peter Oppenheimer there, Goldman Sachs Chief Global Equity Strategist. The bank sector in Europe up 18% so far this year, Tom.
Well, right off the bottom, and that's a book value story. You really wonder on a relative basis where all of the bank book values are. What we haven't covered, John, I've been remiss on this, is not the big banks in America, but the regional banks in the spur. They have, and again, I didn't get this in with Mr. Oppenheimer, but I just wonder what the C-class officer spirit is going to be with a combination of stimulus and equity valuations. You got to believe M&A will be front and center.
Oh, absolutely, Tom. The other story as well is just the pure play on rates. It's a pure play on rates when you start to play with the regionals, Lisa, and that's why we've seen those stocks absolutely flying.
Yeah, they've been incredibly sensitive, and again, it's a question of whether it's a recovery trade or whether it's pricing in future growth, future lending expansion, and future profitability, even in places like commercial mortgages. They hold a lot of those.
Coming up, 8 a.m. Eastern, Sebastian Page, T. Rowe Price, multi-asset strategist. Before we get there, there's a rate decision at 7:45 Eastern, about 35 minutes away. And then after that, there's a news conference with President Christine Lagarde coming under a little bit of pressure over the last couple of weeks. Futures higher by 0.6%. Your bond market bid, your yield on 10s, 150. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
With the First Word News, I'm Rishika Gupta. Within days, millions of Americans will start receiving the $1,400 payments included in the pandemic relief bill. The House has given final approval to the package, and President Biden will sign it into law tomorrow. The $1.9 trillion legislation also extends supplemental unemployment benefits, plus there are health insurance subsidies and child tax credits. And another setback for AstraZeneca's coronavirus vaccine. Denmark has joined other European countries in suspending use of the shot over potentially dangerous side effects. Meanwhile, the European Commission warns that there could be further delays in the manufacture and distribution of the Astra vaccine. Lawmakers in China have taken a big step towards limiting opposition in Hong Kong's political system. The National People's Congress approved an extensive overhaul of how the city chooses its leaders. Amongst other things, there will be a committee to ensure that candidates for office in Hong Kong are, quote, patriots that will effectively end open elections. And we're getting more details on that massive hack of security cameras. Bloomberg's learned that more than 100 employees at Silicon Valley security startup Verkada could peer through the cameras of its thousands of customers. Hackers obtained access to 150,000 cameras, allowing them to see inside Tesla as well as watch police interviews. Verkada says access to the cameras was limited. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
This is one of the most significant pieces of legislation passed in decades. It will do more to help the middle class, poor people and people struggling to get into the middle class than any bill in a very long time.
A $1.9 trillion bill, which the president will be signing tomorrow. Senate Majority Leader Chuck Schumer there. A $1.9 trillion bill that Democrats will be selling, I imagine, for the next couple of years. And Republicans will be spending a lot of time in the next 24 hours trying to slap back down. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. We're counting you down to a rate decision over at the ECB. It's about 30 minutes away, and here's the story for you. Yields come in on a 10-year by almost 2 basis points to 150. We'll get that rate decision at 7:45 Eastern. Then 45 minutes after that, we'll get a news conference with President Lagarde, and you get the forecast from the ECB.
Is it going to be a snooze fest?
I think the forecast will be interesting, Tom, and I think the Q&A session will be interesting as well.
Okay.
I wouldn't call this one a snooze fest. I think there's a bit of pressure here on the leader of the ECB.
Oh, that's going to be interesting to see. I'd also point out, folks, Pacific Rim comes back in all of this churn. It's had a really difficult couple days, and certainly Pacific Rim doing better the last 2 and 3 days. Right now, with the debris in Washington, Kevin Cirilli, our chief Washington correspondent. Kevin, what does the signing ceremony look like? Is it like from my youth? We've had so much gridlock. I can't remember the last signing ceremony, maybe the Affordable Care Act. What's this going to look like when President Biden starts giving out pens?
Well, the Republicans had the tax relief bill. There was a signing relief for that. Look, it's going to be socially distanced, a lot of masks. President Biden is expected to deliver remarks this evening. And then, of course, that signing ceremony, another ceremony on Friday. They're really dubbing this as a victory lap. The President Biden's going to say this is the crowning achievement of his first 100 days in office.
I can't remember who to cite, folks. I'm so sorry for that. But I saw the senator from Mississippi, a Republican, showing some positive spin on the bill as well. How do the Republicans play this? Are they anti-1.9 trillion? Are they anti the check is in the mail?
It was yesterday. Senator Scott of Florida came out and said that he's urging all all states and mayors to return money back to the federal government if it doesn't have anything to do with the COVID-19 relief bill. But no governor or mayor in America
so, Kevin, the senator is saying don't cash the check.
Exactly. Pretty much. I mean, and it's pure politics. But I think yesterday, this point that we've begun exploring, which is that the Republican governors are really the ones with the leverage in the party right now over the short and longer term. And that's a fascinating thread to kind of follow over the next year.
Yeah, I got to say, don't cash those checks. Rings a little bit hollow. I can't imagine people are going to say, okay, then I won't cash that money. There is a question, though, to your point, Kevin, about the idea that governors are taking the front seat. They're not only taking the front seat when it comes to the political landscape on the Republican side, but also in the rollout of some of the COVID pandemic policy. How much is there concern over the self-serving aspect of governors trying to appease the populace by opening more quickly, perhaps, than they ought to, rather than maintaining some of the health instructions, but lose popularity in the short term?
It's like my dad always says, money talks, but I don't always have to listen. And I think from the broader standpoint, as you go forward to your point about the populist streak in the Democratic Party, when they're talking about infrastructure, President Biden's going to say, well, we've got to start with the projects that we need to address as opposed to the top line money number. And so that, I think, is really the thread for infrastructure. When I talk to Republicans throughout the week, especially, they're scratching their heads and wondering how are the Democrats going to propose financing these projects? And so the political capital, as I've noted, that President Biden utilized, he used a lot of capital with Senator Joe Manchin and not really any with the left flank of his party. So that's really going to explode that tension at some point, but we just don't know when.
Well, but on the healthcare side, I mean, aside from the infrastructure spending, on the healthcare side, how much is there a call to nationalize the process of reopening or not reopening, the rollout of the vaccine, and how it's conducted based on this idea that it's difficult politically for governors to keep clamping down on some of the social interactions for health reasons, given that it impedes their ability to get reelected?
Well, I think that there's I think that the decisions Where the Republicans have missed an opportunity is to suggest that reopening is bucking the science. And I think that that's shifting as more people get vaccinated, because there is, as has been explored, when you've got Dr. Fauci saying one thing one day and another thing another day, that leads to a lot of confusion and frustration. I talk to Democrats in this city who are scratching their heads, and you know, these are very liberal people, and they're saying open the schools. And so I don't know if I necessarily agree with that framing, Lisa. I'll be quite frank with you, because a lot of these states are looking at lower rates of diagnosis for COVID-19, and they're beginning to think that it's time.
Do you think the president's trying to have it both ways on a vaccine stockpile, Kevin? When the president turns around and says we're putting America first, we also need to help the rest of the world. We're building up a stockpile now that's north of the population of this country.
Yeah, and I think for President Biden, as he moves forward, again, I mean, to be able to assist in the giant achievement of Merck and Johnson & Johnson and their collaboration efforts and how they're working on the vaccine, you know, I think that that's a really important point to make.
You know, Kevin, we're very quickly, we're out of time. On infrastructure, doesn't the president and everyone else give the gentle lady from the Bronx additional funding for the Harlem River Greenway? I mean, that's the way this works, right?
You know, I think that's an interesting point to make, and especially given the drama with Amazon in that particular district, it'll be interesting to see how that plays.
Kevin, I get the sense when Kevin's got to run. You know, you just get the feeling at
when
the end of the
he
conversation.
Wants to run.
When he shortens down the responses.
When he has to run, or when he wants to.
Chief Washington correspondent.
The difference is, John, is Kevin's on Clubhouse and I'm not.
I get in trouble if I don't do the tease. He's the host of Sound On Bloomberg Radio weekdays.
Oh, yeah, of course.
At 5
See
p.m.
that on Clubhouse.
Eastern. Tom Go. Clubhouse, what?
I mean, John, you're on Clubhouse, right?
I am.
Cirilli's on Clubhouse. Everybody's on Clubhouse.
I don't know what I'm doing. I don't know what I'm doing on it. Got no idea.
Have you done anything?
No. Anne-Marie Hordern over in London, our colleague and co-anchor, she invited me. Apparently you've got to be invited, Tom,
really? You do? That answers why I'm not on Clubhouse.
I'll invite you. I'm not sure if that's still the case, but apparently that's the case.
Joe Weisenthal's on Clubhouse. Brendan Greeley over at the FT is on Clubhouse. What are we missing?
Does anyone actually use it, or is it just to say,
Lisa,
I got invited to Clubhouse?
No, people use it. They do like live podcasts and stuff.
Have you listened to anything on there?
No. Because whenever I click in and listen, I feel like other people might be able to listen to me.
Breathing?
Whatever I'm doing. Yeah, so I just feel weirded out by the whole thing. Maybe we should do a live surveillance podcast on Clubhouse at some point.
John, don't give me any
It should involve
drinks.
drinks.
Invite me then. Yeah.
It should involve drinks.
It will.
And maybe a Premier League football game on a weekend, Tom. That'd be fun.
Yeah, I could see a Clubhouse with the tots. That would really work out.
That would work out.
They have a game today. You know, that's where I am this afternoon.
Commentary.
How do you pronounce it? Dynamo?
There's a more important game. Manchester United versus AC Milan a little bit later.
Oh, yes.
That's a game worth watching. Coming up, Mark Cabana, Bank of America, Global Research, Head of US Rate Strategy. Ahead of that in your bond market right now, a 150 on 10s. Your S&P 500, 39.23. That number right there is wrong. We are up 0.7%, though. From New York City, this is Bloomberg.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
From New York City, this is Bloomberg Surveillance for our audience worldwide, live on TV and radio. Here's the price action this Thursday morning. Always looking at that spread between the performance on big tech and the small caps in America. The outperformance coming from the Nasdaq today was up north of 2 percentage points earlier in the session. Right now, up by 1.76. The Russell still doing okay, up 0.6%. The clues in the bond market, it always is. Switch up the board, 2s, 10s, 30s. Your yield on a 10-year, sub 150 earlier, 150 right now, down 2 basis points. On a 30-year, that's where we get the supply a little bit later. On the Treasury side, on the sovereign side, you get a ton of corporate supply as well. A Verizon bond issue that could be north of $20 billion. A lot of supply to digest through today and into the afternoon. Switch up the board and get to the euro in about 1 hour from now. We'll hear from Christine Lagarde, the ECB president, on the outlook for Europe. We'll get the forecasts, and we'll find out if she's unhappy with what's happening in the bond market. In the FX market, euro dollar 119.63, maybe a little bit more comfortable with that. We've gone from dollar strength to dollar weakness, and give you a flavor of that, Tom, on dollar lira, which right now is a stronger Turkish lira. We had a 3% move on Monday, and this lira is still actually stronger on the week, even with a move of 3% against it on Monday, and that's been the comeback and the fallout from a US dollar that's just been a bit weaker over the last 3 sessions.
Yeah, I agree with the weaker part. It's idiosyncratic. I'm looking at Real as well, a 5.61 on Brazilian Real, again off the Lula news. It's all Damien Sass hour, and we don't do that this hour. We'll do that later this morning.
We're not using that word idiosyncratic.
It's very idiosyncratic.
Idiosyncratic.
You know, it's like what it is.
You get a drink for that.
I get a drink for that.
Enjoy.
Right now, you're going to need a drink after this. Talk about complexity. Ira Jersey's wonderful at this, and so is Mark Cabana. We'll get to that in a moment. We got Romain here to do the equities, right, John?
We do. I need a drink now, too. Euro 119.63. Hey, Romain.
It's a GameStop update, right?
Yeah, GameStop down. There's your update right there. Big Dog higher, Tesla higher. Let's talk about 2 stocks that are actually kind of serious here in the news. This related to COVID, of course. You had Denmark actually pulling the plug, at least temporarily here, on that AstraZeneca COVID-19 vaccine. Some concerns about blood clots. Remember, we already had Austria pull the plug on this as well. So keep an eye on there. And, of course, you know all the sniping between the UK and the EU on the rollout of that. So not good for AstraZeneca. It's London shares down about 2.5%. The ADRs, which is what you're seeing on the screen, down 1.8%. Vir Biotech, this is actually a positive story. Remember, they make these monoclonal antibodies. That's basically the same treatment that President Trump was given when he contracted COVID-19. They're going to apply for emergency authorization immediately. This is a partnership with Glaxo. Their late-stage clinical trial showing about an 85% effectiveness of their COVID-19 treatment. And then AMD, an interesting story here. There's a consortium over in China of chip makers that have basically agreed to work with a consortium of chip makers here in the U.S. to try to alleviate that chip shortage. They're basically going to meet twice a year. It's 10 companies on both sides of the world here. So you're seeing a lot of the chip stocks get a little bit of a bump here. Flip up the board real quickly. Want to take a quick look at Oracle. Oracle shares are taking a huge leg down. They came out with earnings, flat growth, and Brent Thill over at Jefferies really put it best. This is a company right now that has decelerating growth in an industry that has accelerating growth. That's loss of market share when you put that equation together. Roblox, great debut yesterday, $45 as a reference, 64.50 was the open, closed up about 7%. Getting another bid here. You wake up every morning, Tom, you look at what Kathy Wood bought overnight. She bought about 36 million shares of Roblox
she's bounced
for her
back,
generation
right?
ETF.
She bounced back?
Yeah, well, I guess we're not beating her up this week. She's doing well, so she's got her crown back
Crazy.
on. I'm sure. It's a roller coaster ride.
Okay, give me the Bumble update. I need the Bumble update, or I can't go on with
2.7 million paying subscribers on Bumble. But you know what else? You know what the most interesting thing about this was? They actually said they have a platonic app on there called Bumble BFF, Tom. According to Kathy Hurd, the CEO there, she says friendship, Tom, friendship is the next big opportunity here. I already sent you a friend request on there, Tom, and I have not gotten a response yet.
I am doing a SPAC called HR Violation. It's going to be great. It's going to be just, go away. Romaine Bostic, thank you so much this afternoon. I'll have a further Bumble, what'd you call it? Bumble Platonic?
Bumble BFF.
Bumble Platonic update. Well, we're very platonic here. Let's move on to the conversation today. If you're in Global Wall Street.
Just like that.
We can't move on, Tom.
Does
I'm
Mrs.
sorry.
Keane follow this show? I'm sure she does.
Well, at least he's got Bumble BFF to say rather than actual Bumble.
That's his excuse.
Yeah, exactly.
That's his excuse. It's just a ready-made excuse. I'm using it for friends.
I think Jerome's going to be in her TikTok today. That's all there is to it.
Your SPAC HR violation.
Let's get back on the rails.
I promise, Mrs. Keane, I'm using it for friends.
Okay, very good.
Well done, Tom.
This is important for Global Wall Street. Fixed income. Mark Cabana owns a high ground for years at the Open Markets Trading Desk, which is the medieval black box of the New York Fed. And we're thrilled that Mr. Cabana could join us today on the minutia, the interior of the bond market that few in the media ever speak of. Mark, John and Lisa, to be honest, are way better at this than I am. I just want to go to this idea of Operation Twist. Is the chairman of the Federal Reserve going to twist and shout? I just don't believe it.
Not where we sit today. So we had written about a week and a half ago or so that if conditions continued to worsen in the bond market, that this was an appealing option for the Fed. However, what we've seen over the last week is a broad consolidation in the rates market. We saw the 10-year auction go generally fine yesterday. Yep. And what we've seen real rates fall. We've seen the 10-year decline about 10 basis points or so after the last week. And it seems like the market is now finding its footing. So if things don't get worse, there's no reason for the Fed to do anything. And that's what we anticipate at the meeting next week, because the bond market has consolidated and it's found its own footing again.
I want you, with the heritage of Bob Sinch and David Goldman at Bank of America years ago, to calm the gloom crew down now. When you see articles that the short-term paper market is going to come to an end, things are terrible, blah, 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 defend the liquidity of that market, defend the depth of the American short-term market.
Sure. So the front end of the curve is doing just fine right now. There are risks, though, that we see front end rates continue to fall further and potentially go negative. This will likely happen, or there will be real risks of this happening as soon as those stimulus checks get sent. As soon as Biden signs the law, we know that the Yellen-led Treasury Department is going to do their best to get those checks out the door. And when that happens, that's going to increase the overall amount of cash in the banking system, of reserves in the banking system, and that could put additional downward pressure on the front end of the curve. If that happens, the Fed will likely be forced to raise their interest rate on excess reserve and maybe make some other adjustments to their operating tools in order to prevent rates from trading negative. Now, the Fed has tools for that. They're well equipped to do that. And we do anticipate that that will likely be necessary over coming weeks. The truth is, though, that we're not seeing enough downward pressure yet to necessitate a response. But if we do see Fed funds fall another couple of basis points, it's likely that the Fed will take that action.
So, Mark, one thing I've always asked you, and I go back to the same question if you don't mind, is whether the conditions that we're talking about right now are set to persist through the year or fade as the year grows older. What do you expect?
Well, we anticipate that at the back end of the curve, we're going to see continued volatility, and we're going to see higher real rates, and we could see pockets of illiquidity like we saw in the rates market a bit over the last couple of trading weeks. Now, that's going to occur just because the market has to reassess fundamentals. It has to reassess how strong will the economy be? How high will interest rates go? What's the Fed's policy stance going to be? And these are all questions that the market has grappled with. Now, this week, we've seen a bit of a pause in that move higher in rates. But we think that that trend continues, and it will likely continue to challenge the Fed in their policy stance. Look, next week, the Fed's going to have to sound more upbeat on the economy. Why? Well, they're going to mark their forecasts higher. They're going to see this new fiscal stimulus become law. And they're going to have to start talking a bit more optimistically about the market. The risks will not be solely skewed to the downside any longer. And in that context, the Fed is going to start to set the stage for an eventual withdrawal of monetary policy accommodation. That's going to be tough for the bond market to digest, and that's going to likely allow rates to move higher. And as that occurs, you're going to likely see pockets of additional illiquidity.
Well,
so,
Mark, to talk about those pockets of illiquidity, and this is for Tom Keene, both interrupting you as well as talking about bond auctions, because he's got a renewed interest suddenly, or a new interest in bond auctions. How much do you expect bond auctions to repeat what we saw in that disastrous 7-year sale a couple weeks ago?
Yeah, well, in the near term and for the 30-year bond auction today, we think it's going to go fine. The 10-year auction yesterday tailed a little bit, but by and large, it was a standard type of treasury auction. So nothing really to see there. The risks, though, are later in the year, again, as the economy improves, as the Fed starts to sound more optimistic and starts to likely set the stage for a taper and signal that they want to move in that direction. There is a real risk that you're going to see additional, let's call it indigestion in the market of these bond auctions, just because the supply is so large and the Fed's footprint in the market is so big. And once you have one of the biggest market participants aiming to withdraw itself from the market, well, other market participants are not going to necessarily want to enthusiastically step in and take their place, at least not without materially higher interest rates. And there's probably going to be some, again, indigestion and pockets of illiquidity along the way. So we think that this sets the stage for a continued volatile bond market, especially in the first half of this year and into the summer, as the Fed tries to signal that they will be withdrawing accommodation. And what that means for other asset classes is that there will likely be cross-asset turbulence as well. We know that if the bond market is illiquid, and we know if real rates are rising rapidly, that does tend to have spillover effects to other asset classes, equity, credit, and potentially the dollar as well.
Mark, it's always a clinic, and we appreciate your time, sir. Mark Cabana there, Bank of America Global Research Head of U.S. Rate Strategy. A big buyer potentially coming out of the market in the next 12 months or so, or at least reducing their presence. And more importantly, Tom, that big buyer is a price-insensitive buyer, and that's the big issue to try and process this.
Yeah, I really want to say, John, to all of our audience on radio and TV, as these people come on and they try to speak English, the acuity of Mr. Cabana's note, it's almost in Greek, unless you're expert on the short-term market. It's great to have people like him on.
Well, I think on air he does a good job, Tom, of breaking it down in plain English. And actually, it's well aligned with the rest of the team over at Bank of America, because the indigestion that they're looking for in the Treasury market, they're expecting it to bleed over a little bit more, Lisa, into investment-grade credit. And if we start to get spreads wider there, materially so, they think that's where the Fed has to step back in with a bigger presence.
And there is real-world implications here across the board. The idea of higher borrowing costs, making it harder for companies to refinance, raising default risk. And for the government, how much does this put a damper on their ability to keep borrowing to juice economic prospects going forward if rates continue to rise, John?
Coming up on the program, an ECB rate decision in around about 4 minutes' time, and a conversation with Callum Pickering, Berenberg's senior economist.
Flying by.
Going into that, up 26 on the S&P.
No idea.
We advanced 0.7%. A bond market that gives you a yield of 150. We come in 2 basis points. And I can't believe it was you, not me, that said, let's get the show back on the rails.
Bumble BFF.
10 minutes, honestly, after dealing with you day in, day out, it's you that says, let's get the show on the rails. The ECB up next. The news conference 45 minutes later. Full coverage on TV and radio. You sell this show, Tom. Keep selling it.
HR violation.
Here's Bloomberg.
Thank you.
With the First Word News, I'm Ritika Gupta. President Biden is preparing a nationwide victory lap to promote that $1.9 trillion coronavirus relief plan. He'll hold a ceremony tomorrow to sign the measure into law. Then there will be a series of appearances across the nation to ensure voters know that he and fellow Democrats are getting the credit. The bill provides $1,400 direct payments to millions of Americans, and there's also billions in aid to state and local governments. The UK is trying to defend the City of London's global preeminence in finance following Brexit. The government's planning a wide-ranging review of markets. The Economic Secretary to the Treasury, John Glenn, tells Bloomberg that overhauling rules on fintech and IPOs isn't enough. The government also will ask business for proposals to reform capital markets. The emergence of coronavirus vaccines failed to bring more students back to U.S. college campuses. They report that enrollment fell by 4.5% for the spring term, and that included a 16% decline in international students and a 9.5% drop at community colleges. And the Jeep brand has missed out on one of the most lucrative segments of the SUV business. Not anymore. Jeep is debuting 3 large SUVs this year. The largest, the Grand Wagoneer, a land yacht that can cost up to $111,000 when fully loaded. Global news 24 hours a day, on air and up on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
itself spends out over a couple of years. So some of the folks on kind of the overheating team don't recognize the spend out pattern. And then there's slack, okay? There is still way more slack in this labor market. And then, of course, savings. That, too, puts downward pressure on price pressures.
That was Jared Bernstein, the U.S. Council of Economic Advisors member, and his argument as to why this $1.9 trillion plan down in D.C. will not be as inflationary as some people fear. From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramovich, I'm Jonathan Ferro. We're counting you down to an ECB rate decision due in about 20 seconds' time, and sometimes a little bit late. Euro dollar going into that 119.61 and positive a third of 1%. The euro just a little bit stronger. If you're looking at 10-year yields over in Italy, we come in 2 basis points on 10s to about 0.655% after a big repricing across the continent over the last 30 days, in line with what we've seen in treasuries. So this is what we've got to do now as we wait this decision. We'll do rates, and then we'll do the forward guidance, and then a little bit later, we will get some forecasts from President Lagarde. So here's the decision. 0% on the refi, unchanged. 25 basis points on the marginal lending facility, unchanged. And negative 50 basis points on the depot rate, unchanged. Widely expected. Nobody expected any changes. The guidance coming out of the ECB so far, let's get to it, Tom. PEP will run at least through the end of March 2022. So that's the story around the Pandemic Emergency Purchase Program. Full flexibility around buying bonds. That will run until at least 2022. They affirm the size of the Pandemic Purchase Program at 1.85 trillion, and the APP will run until shortly before interest rates rise. PEP can be recalibrated if required. There's some of the headlines coming out of the ECB so far, Tom.
I wish we had a camera on somebody's shoulder here so they could look at my screen. Folks, my screen is all color-coded with the Bloomberg headlines. And John, my overwhelming thought here as a non-sophisticate is the headlines we're seeing here are so un-American. They are so not the Federal Reserve System. It is another world in Frankfurt.
Yields come in just a little bit more over in Italy to 0.64%. They're not big moves. We're down around about 3 basis points. The ECB saying that PEP purchases over the next quarter significantly faster. So that's the headline that matters right now, Tom. That's an ECB that's just leaning into some of the volatility and the high yields that we've seen, the high peripheral spreads that we've seen over the last couple of weeks.
John, how does it dovetail into what we're going to hear in the press conference?
Well, I think it backs up the words of President Lagarde. If she does come out strong with some strong words for the backing up that we've seen on yields over in Italy and in Germany as well. And this idea that they can come in more quickly with the PEP program, that's full flexibility of bond purchases, Tom. Yeah. I think that's really important because it's been difficult to reconcile what we've seen in the bond market with what they've said verbally over the last couple of weeks. So that is some verbal intervention there with some real policy to back it up. Here's our plan. This is how big it is. It has full flexibility, and on the timing of how we deploy it, this is what we're planning to do. And Lisa, so that gives her a little bit of ammunition going into this news conference.
Lisa, the dreaded adverb there, significantly faster, really is what this is all about.
Yeah, significantly faster pace of bond purchases. You do wonder, though, based on the bond action, the price action, whether people are interpreting this as the ECB will buy more Italian bonds. They will buy more Spanish bonds. They will take a more aggressive action there due to their discretion, which they have been, at the expense of perhaps buying more German debts. You do see yields on the margin rising in Germany, which I find actually they're coming down a little bit on the long end now. But I find that interesting, this idea that disproportionately this will benefit Italy.
I would, yeah, I'll go there. I'm going to go to Hamlet and say there's something rotten in Denmark, and it was that headline 2 hours ago on AstraZeneca. Caleb Pickerham advances a discussion, and we welcome all of you on radio and television worldwide with Berenberg, their senior economist. I just have to know now, Callum, the jawboning you will listen to at this press conference today. John has made it clear to me this is not a snooze fest. This is a press conference of import. What will you listen for?
Well, I expect the ECB basically to reaffirm this commitment to buy bonds a little faster in the near term. I mean, at first glance, what we've heard sounds like a fairly well-judged intervention because the ECB is facing what you might describe as a time inconsistency problem. The market has welcomed the big policy intervention around the world. We have rising inflation expectations. Growth momentum is expected to be very strong over the next couple of years. but Europe is still under lockdown, and hence rising interest rates at this moment is not what the economy needs. So the ECB is essentially bought a little bit of time. It'll keep interest rates low, and then probably that welcomed rise in interest rates, reflecting better economic conditions, will come later this year once the economy is opened and once the economic momentum is robust.
Callum, I just wonder how divided the Governing Council is on this plan. The key letter in the acronym PEP is E. It's emergency. It's the Pandemic Emergency Purchase Programme. And for some members of the Governing Council later this year, Callum, they might not consider conditions emergency conditions. How do you see that progressing in the year ahead?
Well, I just like to cast our minds back a year ago. That was a real emergency. We were facing at a global level the prospect of a major financial crisis, a major deflation, and we have had an unprecedented policy response that has worked, and we're not yet out of the woods, and hence the underlying risks are still significant. I think what we will probably see actually over the course of this year is some evidence that might make people worry about inflation risks. A lot of one-off factors will push inflation probably above the 2% target for the ECB during the middle of this year. But the ECB will have to just remind everyone that these are one-off powerful factors that will unwind. We don't think we get on core inflation anything close to 2% over the next couple of years. We think we get close to 1.5% by end 2022. And hence there's still a big justification to keep buying bonds at least for the next 12 months, perhaps even 18 months.
So let's talk about the Japanification of the Eurozone, this idea that the ECB will own a substantial portion of overall debt from the governments in that region. What proportion could that be by the end of this year, Callum?
Look, I have to just jump in there. I don't like this description, Japanification of Europe. If the Eurozone, if Europe would have enjoyed GDP per capita gains as strong as Japan over the last decade, I doubt very much we would have suffered the political uncertainty and the problems that we'd had. The ECB will rapidly expand its balance sheet as necessary to lift inflation expectations, but the real problems come from productivity, from weak investment momentum, and for that we have to look at fiscal policymakers. All the central bank can do is grease the wheels to allow actually commerce to improve with a bit of luck, boosted by some fiscal support. So I think it's other policymakers that we should be thinking about if we're really worried about this so-called Japanification risk.
I gotta say, John, I've never heard that before. When you start talking about Japanification, usually it's a slur almost to an economic policy, considered slow growth and very little inflation for a very long time with a lot of government intervention. Callum just there seemed to say that that was too generous for the Eurozone based on what we're seeing with respect to growth.
Well, let's take a look at what we're seeing in this market right now. Euro dollar 119.49 and coming in a couple of tenths of 1% off session high, still positive a tenth, still a stronger euro, but the bid is in the bond market right now. Italian yields down by 5 basis points to 0.623%, Tom.
Just quickly, John, you take it back to Callum, but John, very quickly here, the Swiss 20-year, which is, you know, somewhat away from Europe, that does the same thing with a more negative yield right now off what we've seen the last few days.
It is a clear response to market conditions, and Callum, I'd go further. I think what's really important here is this is the message from the entire Governing Council this morning. Callum, and I just wonder how much division within the Governing Council there still might be about plans to lean into the financial conditions that we've seen tighten just a little bit, undue tightening, in the words of some ECB officials over the last couple of weeks.
Well, look, I think the Governing Council will want to make sure that the front end of this recovery is a strong one. That's the best bet for actually hitting the 2% target in time. I think one of the issues in Europe at the moment is a worry that actually it's some of the inflationary excesses from the other side of the Atlantic, the US, which are spilling over into the European market. And again, just to repeat an earlier point, rising interest rates tell us actually that growth and inflation expectations are improving. They're a sign that the ECB policy is working, but there's a time inconsistency. If those rates rise before you actually get the good growth in inflation, then it could be an impediment to growth. So I suspect actually there's pretty strong consensus to act against this modest tightening in financial conditions, just to play things on the safe side.
Callum, good to catch up. Callum Pickering there, Berenberg senior economist. So rates, guidance, and then forecasts. Rates unchanged, non-story. Guidance, the plan around the asset purchase program looks a little something like this. Affirming the size of the pandemic purchase program at 1.85 trillion. And here's the kicker. It's the pledge to purchase significantly more quickly over the next quarter to deploy that bond buying, Tom, at a faster pace. And what you see in the market right now is an Italian 10-year down by about 6 basis points to 0.614%. And the whole bond market over in Europe nicely bid as well.
Within all that fancy talk is the word pandemic, John, and I'm sorry, Madame Lagarde is going to have to address the headlines out of Denmark, the headlines out of the EU today. To me, the overarching theme here, particularly against the United States, is the ECB has to deal with a continent, if you will, that just simply can't get the pandemic trend in the right direction.
Totally agree, and I think the compare and contrast that we'll see.
She's got to address it.
8:30 Eastern, Tom. Just compare and contrast what you will hear at 8:30 Eastern to what you will hear in a news conference with Chair Powell on March 17th. When you hear them talk about the forecasts, Chairman Powell is going to have a radically different outlook for U.S. growth, and those revisions are going to be significantly more positive than what I imagine we'll see in about 35 minutes.
And with the criticism of Christine Lagarde, John, frankly, she may be very adept on the political side to address the frustration over the pandemic, as you mentioned Germany earlier and Denmark this morning. She may absolutely nail this morning.
Yeah, I think she struggled with the bond market 12 months ago. A bit of a faux pas, and I think most people would agree that when she said that it wasn't their role to tighten spreads and close spreads in the next 12 months, it turned out that it was. But they got their act together in the end, particularly with that purchase program that we're talking about this morning. On the politics, though, Tom, and I think it's critical, there is something about this outlook that is totally out of her hands, and it's the vaccination rollout. And I think the news out of Denmark this morning is absolutely critical to that. And I sat here and I said earlier, and I'll repeat it, it is not my place to even comment on the analysis coming out of Denmark, but I think we can all agree that it's pretty clear that it undermines the vaccine rollout even more so across Europe, Tom.
Yeah, absolutely. It's just, to me, it's the headline of the morning, and frankly, the headline of the good happening in America.
Coming up, Sebastian Page, T. Rowe Price, multi-asset strategist. Your equity market in America doing better. Your bond market, 148. The bid is in treasuries too. See that spillover from Europe to the US. Treasuries down 4 basis points to 1 point.
We will start soon delivering also COVID-19 vaccines once all permissions have been granted. We are in discussion with Ministry of Health, with current logistic partners in different countries. So we're looking at Southeast Asia right now on delivering COVID-19 vaccines. We are also setting up already on the African continent in already one country and looking at the second country to expand.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I'm pretty convinced that the US is going to see a gigantic rebound, especially in consumption.
There is a huge bounce that's coming as we normalize. There's very high degrees of household savings, which should support a strong rebound when it comes through.
Fed policy inevitably at some point is going to shift.
The market knows that if financial conditions really start to tighten in the U.S., the Fed can do more, a lot more.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene, simulcast radio and television, not a dull Thursday. Claims in this hour, but that is second right now to what we see in the European Union. For our American viewers, John, it's about Christine Lagarde moves the bond market.
She does, Tom, and some better news coming out of Europe, too. The Drugs Agency is set to recommend the J&J vaccine for the block as well.
Boy,
and that's
do they need that.
Much needed good news for the continent on the vaccine rollout. You put it together with the lean-in from the ECB. Yields are aggressively lower in Italy now, down by 8 basis points. We break 60 basis points. It's a pledge, Tom, to take that pandemic emergency purchase program and do more with it up front quickly over the next quarter.
John, in all my years, I've never seen the polarity right now between EU and America. We had the shock Denmark AstraZeneca announcement 2 hours ago, seems ages ago. Look at U.S. futures, they lift.
NASDAQ futures lift, Tom. And would you believe it? This is the interconnectedness of this market right now. You get a bid into the European bond market, you get yields lower on treasuries, and then the NASDAQ accelerates a little bit more as well. So the ECB president, in a small way, it's just a small part of this story, offering a lift to big tech this morning as well, Tom.
Lisa, what's your take here on the soup of all this good news for America, the challenges in Europe, and what it means for the view forward?
To me, I'm struck by the global nature of the bond market right now and how much of a conundrum that presents both the Fed and the ECB as the fates of these regions diverge. The idea that the ECB is trying to say we're not there yet at all and we need to keep monetary conditions even looser than they have been, while the Fed comes in and tries to up their forecast for growth and sort of hedge this gap between both a stronger outlook as well as keeping relatively easy monetary conditions. Bond markets are interlinked. I mean, you could see the bond market in the U.S. responding to what the ECB is doing,
And
Tom.
I note the Pacific Rim coming back after a number of difficult days here, simply doing better. It is a packed hour. What we're going to do is go through this quickly and get to our esteemed guests. Moving to claims at 8:30, moving to Lagarde at 8:30 as well. Moving to John Farrell's The Open at 9 a.m. Look
Thanks,
for that
Tom.
later on in the hour. John, I'm going to do FX. You're going to do bonds.
Okay.
Foreign exchange here. Dollar weaker. Yen churning a 108.48. Euro dollar can't get out of its way. A little bit of euro strength, 119.52. Other than that, I got to go to sterling here, doing a little better, 139.64.
Yeah, the only thing that matters right now, 148 on 10s, Tom. We come in 3-4 basis points, and it's off the back of what we've seen in Europe. And if you're Chairman Powell right now, thank you, Madame Lagarde. Thank you for that one. That takes some pressure off us. We get to talk about the outlook, how great it is, and you get a bond market that's anchored by an ECB pledging to do more. The Italian bond market is bid. Yields are lower now by 10 basis points to 0.578%. An ECB watcher, Frederic Ducrozet, well-known, good friend of this program too, Tom, saying maybe they should just cancel the presser now and just book the profits while they're in, because this bond market's ripping.
I want to reaffirm in the 10-year yield from a 162 to a 148. That's 12, 13 basis point move here that we've seen over the last number of days. Piecing this together, and boy, is this the right guest to have at this right moment. Sebastian Page of T. Rowe Price, yes, a multi-asset strategist, as I've said before. His book, Beyond Diversification, is exceptionally acute about what to do given the maelstrom of news flow that we see today. Sebastian, what is your major message on how to reallocate now? Is it to go back to fundamentals, or is there a new set of rules?
There is a new set of rules in this much lower rate environment. And the number one question, I think, for investors in 2021, Tom, is will rising rates be good or bad for stocks? And I know you talk about it a lot on the show. And, you know, think of things like coffee, egg yolks, red wine, all these things. You don't really know if they're good or bad for you. And it's the same with rising rates. You don't really know if they're good or bad for stocks. Dividend discount model will tell you that if the discount rate goes up, valuations go down. Also, you could think of higher expected returns on bonds. I know right now rates are coming down in Europe, and we're going to see them come down in the US, but we are in a rising rates environment in this recovery phase. So the expected return on bonds goes up, it makes bonds more attractive phase. So the expected return on bonds goes up, it makes bonds more attractive than stocks. But here's the rub, and a lot of your guests have mentioned this before. The Fed is only comfortable raising rates when they expect positive growth, and positive growth surprises are good for stocks. Tom, we just did an analysis that shows if you go back 30 years and you look at all rolling 12-month periods, you can find 72 12-month periods during which the U.S. 10-year yield was up by 50 basis points or more. What do you think is the average return for the S&P 500 over those 17 periods of rising rates? It's a staggering 17%. And the hit rate, percentage of time stocks made money, is 100%. So it's not clear whether rising rates are good or bad for the market. It is the number one question for investors in 2021. It is, in a sense, a new set of rules because of the low level we're starting with and the 25 trillion in stimulus.
Yeah.
Ultimately, right now, we're long the recovery trade, like a lot of your guests, I know.
Well, Sebastian, the key word there is recovery. When we ask ourselves, are real rates, high real rates good for the equity market, we also have to answer the question, where are we in the cycle? If you're in the recovery stage and yields start to pick up, isn't that typically a good thing for stocks?
It is a good thing to stocks because you get positive growth shocks, typically. Again, you also possibly get positive earnings surprises. The earnings forecasts for the year are pretty high, 20, 25, 30%, depending on which parts of the stock market you're looking at. So the bar is high. But yes, rising rates can coexist. You know, you don't necessarily need to say they're good for stocks, but they can coexist with very positive stock returns. And let's not forget, I know you were just talking about the Denmark news and issues with the vaccines in Europe. Overall, the news on the vaccines have been phenomenal. And we track this probability from a group called the Super Forecasters. And they have a probability that you'll have enough doses to inoculate 200 million people by July. That probability prior to Pfizer in November was 10%. It even dipped as recently as January to below 20%. Right now, it's 99%. So it's human nature to focus on the negative side of the news, but the vaccine developments have just been phenomenal. It's our base case that we're in a race between vaccines and new strains. It's our base case that vaccines will win that race.
Vaccines may win that race in certain regions faster than others, and that's what we've seen. We've been talking about it a lot with the U.S. versus the European Union. How much of a boost do U.S. fixed income markets get from very easy and easier ECB policies?
I think you see the market movements this morning. They respond to it. But ultimately, there's a little bit of noise here in there, right? The U.S. bond market will be driven by big macro forces, the forces of the recovery, the stimulus, the fiscal measures, and there will be a lot more driven by what we'll hear from the Fed over the next few weeks. And that will be fairly dovish. So you'll still see, because of the recovery, rising rates, but I don't expect rising rates to negatively impact risk asset returns. So on the margin, Lisa, it's dovish.
Sebastian, good to see you. Sebastian Page there, T. Rowe Price, multi-asset strategist, on this distinction between a better outlook for the United States and a worse one, potentially, relatively speaking, for Europe, and what happens with the bond market. Yes, in many ways, the European bond market can anchor global rates. I would caution those who get too comfortable with that view. Back in 2018, that Bund Treasury spread, Tom, widened out to 279 basis points. That's 100 basis points north of where we are right now.
I go back to GDP differentials here. Take a conservative statistic, 6% GDP growth in Europe, looking at whatever the time frame is. What's the equivalency in Europe, John? 2%?
The outlook for this bond market improves, Tom. 57 basis points on 10s. We're down around about 10 basis points. The outlook improves for the bond market because an ECB is pledging to do more. What about the vaccine rollout? This is the news from the European Drugs Agency. It's said to recommend the J&J vaccine for the bloc, and boy, do we need it in the continent right now. Joining us now is Sam Fazeli of Bloomberg Intelligence. Sam, I want you to set the scene, if you can, first on what's been happening in Europe with the vaccine rollout.
Yeah, hi, Jonathan. Sorry. So obviously it's been slower than expected. I do feel the momentum building. Local pharmacies and doctors are making noises about we're expecting to get doses, mostly of AstraZeneca actually, next week. And now are running around thinking about the logistics of trying to get it into the people's arms. Remember, a lot of Europe is quite much more rural than, for example, Israel or the UK, which has managed to do much more rapid vaccinations. So that's what's going on. And of course, now the challenge is to get the doses to these people.
Sam, why isn't there more Pfizer in Europe? I mean, let's be honest. AstraZeneca is a train wreck right now. Norway just out with a headline on this matter. Dr. Fazeli, why aren't Pfizer and Moderna, with their U.S. success, in Europe more?
Yeah, so, I mean, there are. There's no question about it. And the next one, I think, is coming up. Hopefully will be Johnson & Johnson. But every single one of these companies has hit some kind of production issues or manufacturing issues. So that's what's delivering this or driving this. And also, let's not forget the European Union was relatively slow in getting these deals signed, whatever it is they were worrying about or trying to achieve. So therefore, they end up at a slightly different point in line. And I have to say, the issue with the AstraZeneca vaccine is you're going to hear this from other vaccines. As they start getting rolled out, somebody has a reaction, and the local authority or the health authority does what is right, and that says, okay, let's stop, let's assess, and go back. And that is absolutely the right thing to do.
Okay, so that's the right thing to do, Sam, but how much does that give credence to some of the skeptics of vaccination, saying it's too early, this has been untested, it's been rolled out in months, and you got the likes of Denmark raising questions about some of the health ramifications. What do you say to those people?
Yeah, so what you have to tell them is that I would rather have my health system keeping an eye on side effects and issues as they arise, if they are related to the vaccine, and making sure they're not, than covering this kind of stuff up and then ending up with an actual problem. So this is absolutely the right way to do it. And skeptics or no skeptics, any vaccine that's rolled out has to be looked at under the microscope like this, and they will be. And there will be other issues like this that turn up. And let's be honest, we have no idea what this is to do with. Close to 24 million people have been vaccinated in the UK. I estimate 2/3 with the AstraZeneca vaccine. Where's that news? None.
Sam, it's great to catch up, sir. Sam Fazeli of Bloomberg Intelligence. Another headline crossed on a Bloomberg, this reportedly coming out of Norway, to pause vaccinations with AstraZeneca. The Institute of Public Health holding a news conference over in Norway right now. The decision is precautionary, Lisa, to gather information.
Yeah, on the flip side, you've got the United Kingdom coming out and saying the AstraZeneca COVID vaccine is safe, despite the concerns being raised by the likes of Denmark and Norway, which raises sort of this conundrum. How do you accelerate the take-up of vaccinations while also being really transparent about any emerging scientific evidence of side effects?
Shout out to the team over in Frankfurt, Germany, that lead our ECB coverage, because another headline crosses the Bloomberg, and Tom it's remarkable some of the reporting the team does, because this is some reporting ahead of a news conference that hasn't even started yet in 17 minutes. The ECB is said to agree that the risks to the outlook have become more balanced.
What does that mean?
Usually they would say that the risks to the outlook are tilted to the downside, and one thing that you might get from President Lagarde in about 17 minutes' time is that the risks to the outlook are still tilted to the downside, that they are increasingly becoming more balanced. So I don't want to get ahead of what the President of the ECB has got to say, Tom.
I have no
Slightly
idea.
more constructive, I think, is what you've got to say.
Whatever that means.
Is that
maybe
helpful?
she'll be on Clubhouse.
Norway and Denmark are pausing the AstraZeneca shot. Sweden says no reason to change the recommendation on the AstraZeneca shot. You are going to hear a lot more out of Europe on this topic. From New York City this morning, good morning. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Thank Speaker Pelosi and the House of Representatives today for passing the bill, and I will be signing into law shortly. This bill represents a historic victory for the American people. I look forward to signing it later this week.
A $1.9 trillion effort down in Washington, D.C., and a president of the United States will be signing that in the next 24 hours. From New York City this morning, good morning. Alongside Tom Keene and Lisa Brambis, I'm Jonathan Ferro. Let's get straight to the bond market this morning as we count you down to an ECB news conference in Frankfurt, Germany, with President Lagarde. We have a bid on 10s in the United States. Treasury yields come down 2 basis points to 149.36. We've got a monster bid on 10s in Italy. We're down 9 basis points to 0.58%. And we've got a clash across the continent. There are a couple of news conferences happening simultaneously on the continent around the use of the AstraZeneca vaccine across the European Union. Tom, what we've heard so far this morning was Denmark pausing the use of the shot. Norway follows up by doing basically the same thing, and then Sweden says at this point no reason to change the recommendation. And when you have different countries doing different things with the same vaccine, what do you get? Confusion.
Well,
we don't want confusion at a time like this.
You get the United States of Europe, John, not the United States of America. The hallmark, folks, of Bloomberg News is our ability to bring in global headlines from every source worldwide. And, John, I can't emphasize enough the cacophony of headlines in the last 90 minutes, maybe 100 minutes, has been truly extraordinary.
And the tension between the different countries. So there is a single batch, reportedly, of an AstraZeneca vaccine over in Italy. The Italian authority to ban the use of that particular batch, just to be precise with my words, because it really does matter at this point. There's a UK agency out on the wires at the same time commenting on the AstraZeneca vaccine after this suspension in Denmark and elsewhere, that people should still go and get the COVID-19 vaccine. And it's this single one. It's the AstraZeneca vaccine. And I want to be really clear with everyone at home. Nobody on this program is qualified to say anything about this particular vaccine. We're just here to bring you the news and talk about what's happening across Europe right now. The read across, though, Tom, is pretty clear. This will undermine public confidence in this vaccine rollout.
You've got the polarity of stocks up big, 2%, NASDAQ 100 in Europe, and all this news in Europe. And, John, I just sent a message to our radio leadership about this unusual press conference. This time may be different. This may be a really interesting hour and a half with Madame Lagarde.
As the outlook got better, not good enough, an undue tightening of financial conditions and an ECB willing to buy more bonds, and that's what's moving the bond market today. Then our team over in Frankfurt, Germany, reportedly saying that when we get those forecasts, we'll get a nice little language shift maybe around those forecasts too, that the risks around the outlook have become a little bit more balanced. I think it's going to be very interesting in 10 minutes' time.
We'll monitor this very carefully, jump in with any data that really moves. Right now, and this is well-timed, Sarah Bianchi joins us working with Edward S. Hyman over at Evercore ISI, head of U.S. public policy and political strategy, and actually very experienced in the Washington science of gridlock. Did we just see, Sarah, the end of gridlock? Is this what less gridlock looks like?
Well, it certainly is an impressive victory, even though there were no Republicans on this bill. With the 50-vote Senate, it's a very narrow majority, and really holding all of them, you have to give your hats off to President Biden and his team and a narrow majority in the House. So I think they're showing you that they were sent here to get things done. Now, their next package is going to be even harder, so I'm not sure the era of gridlock is over. They're going to try to do things that have taxes and more difficult spending. So we got some rough sledding to go, but certainly today they ought to feel very good.
Sarah, is there any chance of a bipartisan infrastructure bill?
You know, I think there's a possibility that they could pull off some of the infrastructure pieces and try to pass that in a bipartisan way. What we've seen is Senator Manchin already saying, I'm not going down this other route again. I've done this reconciliation only thing. So they're at least going to have to get caught trying. But I don't think you're going to see Republicans really biting on some of these tax revenues that Democrats are talking about. So the only way I see bipartisanship is if they're willing to pull off, call it 500, $1 trillion just on infrastructure, and then try to do the rest on their own as Democrats.
Sarah, does $1.9 trillion do income replacement in the emergency of the have-nots of America, or can it actually advance prosperity and productivity in America?
There's a lot in this bill for everybody. There is checks and there is child resources for families with children. But there is also some testing and some vaccination money that should benefit all of us. across the board. I think really the next bill is designed to really strengthen the country. That's where the infrastructure comes. That's where the R&D comes for things like 5G and semiconductors. So I think the next one is really more of an investment in the country. But this one, again, the biggest stimulus for all of us is if we can get out of COVID. And so I think all of it will be benefit to everyone. But it's not all the answers for sure.
Sarah, good to see you, and we appreciate your insight. Thank you. Sarah Bianchi there of Evercore ISI, as we continue to count you down to an important news conference in Frankfurt, Germany, that begins in about 7 minutes' time. There is a bid in the bond market across Europe and in the United States to some degree as well, and largely because the ECB has come out this morning, left policy unchanged, but pledged to do more with an existing bond buying program and do more up front, leaning in to the high yields that we've seen in the last 30 days. So what do you get? You get lower yields in Italy by 9-10 basis points, and largely the same story across the continent. The story for me, though, Tom, is around communications. I've spent a lot of time talking to many people in this market who are very close ECB watchers, who are a little bit unconvinced about the communication coming out of the ECB at the moment. We had a really clean signal in the press release about 45 minutes ago. And in the last 20 minutes, we've had some reporting from our fantastic team in Frankfurt, Germany, that undermines some of the signaling coming out of the ECB and leaks some of this story just before the news conference actually begins, that President Lagarde is set to tell us perhaps that the outlook has become more balanced. And Tom, I think there is a conversation ongoing about whether there are people within the Governing Council willing to undermine and get out in front of the ECB chief.
She's going to have to address that. I mean, it's completely foreign to the news flow that we see, not that we think, but what we hear from our esteemed experts, Callum Pickering on with us a bit ago. I'm not hearing balanced from market economists, John.
Not right now. Will we get that balance in the outlook, Lisa? We'll get the forecast in about 10 minutes.
It's very tricky because she's going to also have to parse out how much does the ECB have to step in and respond every time there's a delay in the vaccination rollouts. I mean, there's sort of this sort of asymmetric risk for the ECB to do too much and then all of a sudden have nothing left if there is a true problem, John. I mean, honestly, I'm struck by this difficulty that they have managing a problem in real time that seems to be getting worse if you look at the AstraZeneca news today.
Can I mention, John, claims as well?
Sure, yeah, in 5 minutes. And the claims are going to be too high, north of 700,000.
That's where the survey is 725,000 here. Anything, what do you think? I think anything under 650 is huge deal.
I think, this is what I think we've got to get back to twos and fast. Yeah. And I think that's what this central bank wants to see. And I think that's what the fiscal policy side of things wants to see as well. When a central banker speaks, it's got to have credibility and authority. Will the Governing Council undermine that at the ECB? And what does the ECB president have to say about that? An important news conference is coming up on this program. We'll bring you initial jobless claims first in America, an important data point. And then we'll get to the news conference in Frankfurt, Germany, with an ECB pledging to do more up front and lead in to market conditions, and a bond market that responds appropriately. Yields are lower in Italy, yields are lower across Europe, in the United States too, and a euro that stays firmer. Your forecast, your news conference, your claims next. This is Bloomberg.
Just COVID, but it's COVID related, but it's also stress related to job. I think COVID probably just sort of was the nail in the coffin for a lot of us. having the destruction room here is also a very healthy outlet. I do not encourage it as something that we do on a regular basis, but I do find that when people come in, being able to break plates, being able to write out whatever's on their mind and letting it go, being able to just take out their frustration and their anger.
We're thankful to be able to come to a place like this and be able to break some stuff and release some tension without going to jail.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
From New York City for our audience worldwide, this is Bloomberg Surveillance alongside Tom Keene and Lisa Abravitz. I'm Jonathan Ferro. Equity futures nicely bid. A couple of things to get through in the next 30 minutes or so. We've got to bring you initial jobless claims in America, then head to Frankfurt, Germany for a news conference with the ECB President Christine Lagarde. Before we get you there, let's get some data with Michael McKee.
Well, happy pandemic anniversary, John. Was a year ago today that the World Health Organization declared this a pandemic, and we started seeing enormous jobless claims, and we still do. 712,000 last week. That is a little bit lower than the forecast for 725,000. The initial report last week was 745. So we're looking at a drop of about 35,000, 33,000 on the week, but we're still over 700,000. And I don't know if we have this chart ready, but this is the 51st week that we have been above the previous record high of 695,000, which was back in 1982 when Tom Keene still wore regular ties. It has been a very long period of bad news.
I'm going to look, Michael McKee, as we go to Lagarde here. 1, 2, 3, 4, 5, 6, 7, 8 weeks where we've got a modest trend of the grimness of middle January. Is that a legitimate trend to you, and for that matter, to Chairman Powell?
It does seem to be a legitimate trend, but again, we can't trust the exact numbers because there's double counting, because there's been shown to be fraud. We don't know exactly how many claims are out there, but as long as you're looking at those kind of numbers, you're looking at bad news for the overall economy. And the 4-week total of claims out there is back up over 20 million, dropped to 18 million in the week of February 13th, week of February 20th, we're over 20 million again.
Michael McKee, thank you so much. We have Madame Lagarde now. We'll get more from Michael McKee through the morning. John?
Let's head to Frankfurt, Germany right now to listen to the ECB President.
Measures are weighing on euro area economic activity in the short term. Looking ahead, the ongoing vaccination campaigns, together with the envisaged gradual relaxation of containment measures, underpin the expectations of a firm rebound in economic activity in the course of 21. Inflation has picked up over recent months, mainly on account of some transitory factors and an increase in energy price inflation. At the same time, underlying price pressures remain subdued in the context of weak demand and significant slack in labor and product markets. While our latest staff projection exercise foresee a gradual increase in underlying inflation pressures, it confirms that the medium-term inflation outlook remains broadly unchanged from the staff projections in December 2020 and below our inflation aim. In these conditions, preserving favorable financing conditions over the pandemic period remains essential. Financing conditions are defined by a holistic and multifaceted set of indicators spanning the entire transmission chain of monetary policy, from risk-free interest rates and sovereign yields to corporate bond yields and bank credit conditions. Market interest rates have increased since the start of the year, which poses a risk to wider financing conditions. Banks use risk-free interest rates and sovereign bond yields as key references for determining credit conditions. If sizable and persistent increases in these market interest rates, when left unchecked, could translate into a premature tightening of financing conditions for all sectors of the economy. This is undesirable at a time when preserving favorable financing conditions still remains necessary to reduce uncertainty and bolster confidence, thereby underpinning economic activity and safeguarding medium-term price stability. Against this background, the Governing Council decided the following. First, we will continue to conduct net asset purchases under the Pandemic Emergency Purchase Programme with a total envelope of 1,800 billion euros until at least the end of March 22, and in any case, until the Governing Council judges that the coronavirus crisis phase is over. Based on a joint assessment of financing conditions and the inflation outlook, the Governing Council expects purchases under the PEP over the next quarter to be conducted at a significantly higher pace than during the first months of this year. We will purchase flexibly according to market conditions and with a view to preventing a tightening of financing conditions that is inconsistent with countering the downward impact of the pandemic on the projected path of inflation. In addition, the flexibility of purchases over time, across asset classes and among jurisdictions, will continue to support the smooth transmission of monetary policy. If favorable financing conditions can be maintained with asset purchase flows that do not exhaust the envelope over the net purchase horizon of the PEP, the envelope need not be used in full. Equally, the envelope can be recalibrated, if required, to maintain favorable financing conditions to help counter the negative pandemic shock to the path of inflation. We will continue to reinvest the principal payments from maturing securities purchased under the PEP until at least the end of 2023. In any case, the future roll-off of the PEP portfolio will be managed to avoid interference with the appropriate monetary policy stance. Second, net purchases under our Asset Purchase Programme, APP, will continue at a monthly pace of 20 billion euros. We continue to expect monthly net asset purchases under the APP to run for as long as necessary to reinforce the accommodative impact of our policy rates and to end shortly before we start raising the key ECB interest rates. We also intend to continue reinvesting in full the principal payments from maturing securities purchased under the APP for an extended period of time past the date when we start raising the key ECB interest rates, and in any case, for as long as necessary to maintain favorable liquidity conditions and an ample degree of monetary accommodation. Third, the Governing Council decided to keep the key ECB interest rates unchanged. We expect them to remain at their present or lower levels until we have seen the inflation outlook robustly converge to a level sufficiently close to but below 2% within our projection horizon, and such convergence has been consistently reflected in underlying inflation dynamics. Finally, we will continue to provide ample liquidity through our refinancing operations. In particular, our third series of targeted longer-term refinancing operations, TLTRO, remains an attractive source of funding for banks, supporting bank lending to firms and households. Preserving favorable financing conditions over the pandemic period for all sectors of the economy remains essential to underpin economic activity and safeguard medium-term price stability. We will also continue to monitor developments in the exchange rate with regard to their possible implications for the medium-term inflation outlook. We stand ready to adjust all of our instruments as appropriate to ensure that inflation moves towards our aim in a sustained manner in line with our commitment to symmetry. Let me now explain our assessment in greater detail, starting with the economic analysis. Following the strong rebound in growth in the third quarter of 2020, Euro area real GDP declined by 0.7% in the fourth quarter. Looking at the full year, real GDP is estimated to have contracted by 6.6% in 2020, with the level of economic activity for the fourth quarter of the year standing 4.9% below its pre-pandemic level at the end of 2019. Incoming economic data, surveys and high-frequency indicators point to continued economic weakness in the first quarter of 2021, driven by the persistence of the pandemic and the associated containment measures. As a result, real GDP is likely to contract again in the first quarter of the year. Economic developments continue to be uneven across countries and sectors, with the services sector being more adversely affected by the restrictions on social interaction and mobility than the industrial sector, which is recovering more quickly. Although fiscal policy measures are supporting households and firms, consumers remain cautious in the light of the pandemic and its impact on employment and earnings. Moreover, weaker corporate balance sheets and elevated uncertainty about the economic outlook are still weighing on business investment. Looking ahead, the ongoing vaccination campaigns, together with the gradual relaxation of containment measures, barring any further adverse development related to the pandemic, underpin the expectation of a firm rebound in economic activity in the course of 2021. Over the medium term, the recovery of the euro area economy should be supported by favorable financing conditions, an expansionary fiscal stance, and a recovery in demand as containment measures are gradually lifted. This assessment is broadly reflected in the baseline scenario of the March 2021 ECB staff macroeconomic projections for the euro area. These projections foresee annual real GDP growth at 4% in 21, 4.1% in 22, and 2.1% in 23. Compared with the December 2020 Eurosystem staff macroeconomic projections, the outlook for economic activity is broadly unchanged. Overall, the risks surrounding the euro area growth outlook over the medium term have become more balanced. although downside risks remain in the near term. On the one hand, better prospects for global demand, bolstered by the sizable fiscal stimulus and the progress in vaccination campaigns, are encouraging. On the other hand, the ongoing pandemic, including the spread of virus mutations, and its implications for economic and financial conditions, continue to be a source of downside risk. Euro area annual inflation increased sharply to 0.9% in January and February 21, up from minus 0.3% in December. The upswing in headline inflation reflects a number of idiosyncratic factors, such as the end of the temporary VAT rate reduction in Germany, delayed sales period in some euro area countries, and the impact of the stronger than usual changes in HICP weight for 2021, as well as higher energy price inflation. On the basis of current oil futures prices, headline inflation is likely to increase in the coming months, but some volatility is expected throughout the year, reflecting the changing dynamics of the factors currently pushing inflation up. These factors can be expected to fade out of annual inflation rates early next year. Underlying price pressures are expected to increase somewhat this year due to current supply constraints and the recovery in domestic demand, although pressures are expected to remain subdued overall, also reflecting low wage pressures and the past appreciation of the euro. Once the impact of the pandemic fades, the unwinding of the high level of slack, supported by accommodative fiscal and monetary policies, will contribute to a gradual increase in inflation over the medium term. Survey-based measures and market-based indicators of longer-term inflation expectations remain at subdued levels, although market-based indicators have continued their gradual increase. This assessment is broadly reflected in the baseline scenario of the March 21 ECB staff macroeconomic projections for the euro area, which foresees annual inflation at 1.5% in 21, 1.2% in 22, and 1.4% in 23. Compared with the December 2020 Eurosystem staff macroeconomic, the outlook for inflation has been revised up for 21 and 22, largely due to temporary factors and higher energy price inflation, while it is unchanged for 23. Turning to the monetary analysis, the annual growth rate of broad money stood at 12.5% in January 21, after 12.4% in December and 11% in November 20. Strong money growth continued to be supported by the ongoing asset purchases by the Eurosystem, which remain the largest source of money creation. The narrow monetary aggregate M1 has remained the main contributor to broad money growth, consistent with a still heightened preference for liquidity in the money holding sector and a low opportunity cost of holding the most liquid forms of money. Developments in loans to the private sector were characterized by somewhat weaker lending to non-financial corporations and resilient lending to households. The monthly lending flow to non-financial corporations continued the moderation observed since the end of the summer. At the same time, the annual growth rate remained broadly unchanged at 7% after 7.1% in December, still reflecting the very strong increase in lending in the first half of the year. The annual growth rate of loans to households remained broadly stable at 3% in January, after 3.1% in December, amid a solid positive monthly flow. Overall, our policy measures, together with the measures adopted by national governments and other European institutions, remain essential to support bank lending conditions and access to financing, in particular for those most affected by the pandemic. To sum up, a cross-check of the outcome of the economic analysis with the signals coming from the monetary analysis confirmed that an ample degree of monetary accommodation is necessary to support economic activity and the robust convergence of inflation to levels that are below but close to 2% over the medium term. Regarding fiscal policies, an ambitious and coordinated fiscal stance remains critical in view of the sharp contraction in the euro area economy. To this end, support from national fiscal policies should continue, given weak demand from firms and households relating to the ongoing pandemic and the associated containment measures. At the same time, fiscal measures taken in response to the pandemic emergency should, as much as possible, remain temporary and targeted in nature to address vulnerabilities effectively and to support a swift recovery. The three safety nets endorsed by the European Council for workers, businesses, and governments provide important funding support. The Governing Council recognizes the key role of the Next Generation EU package and stresses the importance of it becoming operational without delay. It calls on member states to ensure a timely ratification of the own resources decision, to finalize their recovery and resilience plans promptly, and to deploy the funds for productive public spending, accompanied by productivity-enhancing structural policies. This would allow the Next Generation EU programme to contribute to a faster, stronger, and more uniform recovery, and would increase economic resilience and the growth potential of member states' economies, thereby supporting the effectiveness of monetary policy in the euro area. Such structural policies are particularly important in addressing long-standing structural and institutional weaknesses and in accelerating the green and digital transitions. Thank you very much. We're now ready to take your questions.
Thank you very much, Madame Lagarde. And as the President said, we have changed a little bit the setup and the visual of the press conference, and we hope you like it. And now the first question goes to Johanna Treek of Politico EU. Johanna, please.
Yes, thank you very much. This is Johanna. Ms. Lagarde, you announced that the ECB will significantly increase the bond buys over the next few months. Given the inbuilt flexibility that you have, what has kept you from increasing the purchases so far? And my second question would be, you said significantly. Could you perhaps quantify that for us a little bit? Where does it start? At 25 billion a week or closer to 30 billion a week? Thank you.
Okay, guys, let's have a little break from Bloomberg Television, from Lagarde. Let's see how much profit we made, because we closed already our two positions on euro. And as you can see, on first position, we have profit, £9,240. On another position, we have loss. We sold at 119,530, and total profit, if we will take out from our profit and loss, total profit we got £6,040. Okay, great trade. It's worth to keep your positions overnight. Don't try to play stop loss like some other teachers trying to teach you. Just do what you think is right. If you don't know how we did it, why we did it, you have a strategy. It's not complicated strategy. If you want to follow in our trades, you are welcome to follow our trades. But this is what we're trying to explain all our traders and investors: how to calculate, how to do quantitative trading, how to get involved in day trading, how to include all these math, all this calculation together with technical analysis into this trade and how to make profitable trade. For years, we never made any losses at all. So well done, all people who did follow trades, who made profit, you deserve it. And let's see, let's find another pair that will bring us as well good profit. Stay safe.
I said was to preserve favorable financing conditions. Point number one. Point number two, we have full flexibility under PEP. That is you know, the cornerstone of PEP. But to actually assess jointly favorable financing conditions, determine their favorability in relation to the inflation outlook, we are not bound by any particular specific number. So what the Governing Council has decided is to, and I'll read exactly the sentence because I don't want to stay away from what was decided by total consensus, by the way. The Governing Council expects purchases under the PEP over the next quarter to be conducted at a significantly higher pace than during the first month of the year. So this is what what has been decided by consensus of the Governing Council. Significant increase of the purchases. We are looking at a time horizon of a quarter, which conveniently coincides with the staff provisions that we receive on a quarterly basis, and which will enable us to actually identify whether the financing conditions have evolved, remain favorable, and actually help us to counter any downward pandemic effect on our inflation path. Now, I'm also happy to explain exactly what we mean by financing conditions and favorable financing conditions, because I know that this was a question that many of you had. So, shall I do that? Yes. And I'm sorry if I'm stealing the thunder of some of those who wanted to ask that question, but I know that it's a question that is on your mind. So, when we measure financing conditions, I use two words that some of you found either questionable or a bit strange. I use the word holistic, and I use the word multifaceted. Now, it wasn't a fancy or a tantrum on my part. It was very targeted at particular indicators. So let me take you through the holistic first. What we mean by holistic is that we cover the whole chain of transmission, from upstream stage, where you find the risk-free interest rate, where you find the sovereign yields, to the downstream aspect of the credit terms. And that clearly includes a multiplicity of rates that we all look at as well. And it has to do with a stage where monetary policy acts with a lag. So upstream, essentially down to interest, to risk-free interest rate, sovereign yields. It's a segment that actually responds quite rapidly, which is measured on an ongoing basis, and where our monetary policy can be most efficient. But that's not enough. What's important is that actually financial institutions, those that provide financing to the economy, actually use those rates to determine the credit terms that they are then going to offer. So that upstream is clearly an important component, but it is not the component of our assessment of the financing conditions, which is why I use the word holistic. We go from upstream to downstream. And the second word that I used, which is multifaceted, was also apparently a bit of a puzzle for some. Well, multifaceted, we organize information in a multidimensional form. That might be more convenient for some of you, where each indicator can be studied in its own right, and assessment is not based on an aggregated synthetic measures. So we don't operate mechanically. We look at all the indicators, We focus indeed on what is upstream because that's where we can act, and that's where banks and providers of financing actually take their clue about the credit terms that they're going to offer. And it's also important to be multifaceted because there are some downstream components that are not necessarily going to be influenced by upstream movement. Take, for instance, some fiscal measures that have rightly been decided, such as providing moratorium or guarantees. If that was withdrawn, well, clearly it will have an impact on the downstream aspects of the indicators. In the same way, our TLTRO is also helping the downstream aspect of what we're looking at. So that's the reason why we look at financing conditions, looking at the upstream, the downstream, but looking at them in their own right, in a holistic way, all of it, the whole transmission chain, and each and every one of them, because they might respond differently depending on what is addressed to them. Now, the second question, of course, is how do we assess favorability? Well, if you look carefully at the introductory statement, we refer to a joint assessment of how financing conditions and our inflation outlook have evolved since last time we identified favorability and concluded with our assessment. And we look at the main drivers, of course. So, concerning the anchor that I have used as well last time we had the press conference, it's the inflation outlook. The assessment of the financing conditions, determination of how favorable they are, is going to be done in conjunction with the inflation outlook. And the compass that we have, another word that I used as well, are the financing conditions. So we use all that, and with a bit of good work, good analysis based on provisions and this joint assessment, our monetary policy will contribute to taking the economies across the bridge of the pandemic that we are suffering from and have been suffering from for the last year or so. Thank you.
Thank you, Madame Lagarde. And the next question goes to Alexander Weber of Bloomberg News. Alexander, please.
Good afternoon, President Lagarde. So on the rise in bond yields, we've heard different views from governing council members in the past few weeks, and some said that it can be warranted if it reflects a better outlook. So which arguments were presented over the last few days, and what exactly led you to conclude that bond purchases must pick up in the coming quarter? And then also a second question on this change in language. Should market participants expect a change in the pace of pet purchases only after governing council meetings? So do you think it's important to first build a consensus on that? Thank you.
Thank you very much. On your last point, as I said, quarterly basis is very convenient because it helps with having the right data, the right assessment, the provisions of our staff, sometimes checked by the national central banks as well twice a year. So we have fresh data, fresh information that is extremely useful in order to look at these two components that I have discussed. The anchor, inflation outlook, how does it evolve? How does it look like in the medium term? And the compass that we use, which are the financing conditions, which we committed to preserve as favorable in order to resist the downward impact of pandemic on our inflation path. So we're not monitoring on a weekly basis. I know that some of you listening are looking at weekly numbers. Fair enough. But the Governing Council is not micromanaging the operations. And on that vein, actually, I would like to tell you that when you look at this coming Monday, don't expect a huge, big rise, okay? Because the decision was taken today. We have still a good volume of redemptions this coming Monday. But I can also tell you that we're beginning to implement the decision that was taken today to significantly increase our purchases as of today. So the real pace on a weekly basis, which some of you are interested in, is not going to be visible or strongly visible this Monday. But again, you know, we're looking at a time horizon which is longer than the next week. And the Governing Council meets any time when it's needed. We're getting very close to the first anniversary of days when we were meeting almost on a daily basis. And that's when we started PEP. So if it is necessary, in order to respond with flexibility and to deliver on our commitment to preserve favorable financing conditions, the Governing Council can always meet. But clearly the Executive Board can also use the flexibility that is embedded in the program in order to actually deliver on the decision that was taken today, which is to use flexibility in order to significantly increase our purchases. Thank you.
Thank you, Madame Lagarde. And the next question goes to Balazs Korani of Reuters. Balazs, please.
Good afternoon. Thanks for taking my questions. First one is about the goals of your decision today. I'm curious, is your aim to improve financing conditions compared to where they were, let's say, this morning, or to preserve the levels you have now? And if you want to improve them, what is the benchmark? Philip Lane put up some charts a couple of weeks ago showing curves in December. Is that your goal, to go back to the December level, or where is the favorable financing conditions level? And the second question is, did anybody at the table suggest, propose, or make the argument for increasing the total envelope for PEP? Thank you.
Well, let me remind you once again that when we assess favorable financing conditions, we do it with a series of indicators that go from upstream to downstream. I think that Philip actually in his recent speech very clearly indicated what was the composition of those upstream and downstream elements and what was the interconnection between the two and why the upstream actually mattered, without prejudice to us also looking very carefully at the downstream. So we do that on the one hand, and to assess favorability, we look on a quarterly basis at the inflation outlook. And on the basis of the commitment we made to preserve favorable financing conditions, that determines the decision that is made by the Governing Council. And on the occasion of this particular monetary policy decision, the Governing Council, by consensus at the table, decided that it was warranted to significantly increase purchases for the next quarter with a monthly reference. So, there is no reference to a particular day. There is no reference to any kind of yield curve control, if it is the question that you are angling to. We're not doing yield curve control. We are preserving favorable financing condition with a look at the inflation outlook that we have and how one contributes to reducing the downward impact of the pandemic on our inflation path. Thank you.
Thank you very much.
Total envelope.
Oh yeah. You asked about the envelope. Well, look, what we did with the envelope was quite spectacular, I would suggest. It was decided on March 18. It was subsequently increased by 600 billion euros in June. It was then again increased by 500 billion euros in December. And in December, we clearly focused on the preserving favorable financing conditions. If I have not repeated it 10 times, I don't think I will have said it. So that's what we did. And for the moment, we probably have about 1 trillion euros left in the envelope. And it's very clear also in the introductory statement. To preserve favorable financing conditions, if we need less than the whole envelope, we will not use the whole envelope. If equally, to preserve favorable financing conditions, we need to recalibrate the whole envelope, we will do so. So again, it's flexibility in the monthly purchases under the quarterly decision that is made by the Governing Council, and it's flexibility as to how we use the overall envelope during the life of PEP. Thank you.
Thank you. And the next question goes to Eric Albert of Le Monde. Eric, please.
Hello, thank you very much for having me. A couple of questions first on the headline inflation that is likely to increase, as you said. The problem, of course, is you justify your intervention by saying you needed to increase inflation in the past. If headline inflation gets to 2%, what arguments are you going to use to justify your intervention? And one other question, if I can, on climate change. You had a paraglider on your roof yesterday. You debated the issue, I think, a few weeks ago, and the leaks were that the ECB intervention might not extend to choosing bond buying according to the CO2 emission of companies. Is that correct, or will you keep the market neutrality mantra?
Well, thank you so much for the two questions. On the first one, let me make a few comments about inflation. Because if you look at the staff provisions that will be released later this afternoon, you will see that our inflation forecast is of 1.5 for this year, and then moves down to 1.2 and then 1.1, and finishes in 2023, which is our medium-term horizon, at 1.4. It is possible that this year, particularly at the end of 2021, inflation actually hits 2%. But I will tell you something. We will see through that for a very clear reason. And that is that inflation will most likely go up, possibly to 2%, because of some technical and temporary reasons. Let me just mention a few, and we can go through the list. But it's number one, the VAT, the German VAT return, which has had an impact, an upward pressure on prices. It is the significant modification of the weighing in the HICP balance to adjust to the change of consumer behavior and consequences that it has in 21. It has to do with some idiosyncratic factors having to do with, I think, Italy and France that have extended into 21 some of the sales, particularly in the clothing industry. And it has to do, of course, with the increase in prices in the oil segment. So for all these reasons that are, we believe, temporary, technical, as I have just tried to explain, we will see through that. And it is important for us to actually look at what happens next and to look at the medium-term inflation outlook. And there, we are clearly seeing subdued inflation. Why is that? Well, because demand, subdued demand. Second, because of the slack in the economy that will gradually, over the course of the recovery, reduce, but which is large and has a significant impact. Wage pressure. There is clearly limited pressure up on wages, and also the impact of the euro appreciation. So for all these reasons, we believe that while it has increased a little bit in the first 2 years, on the third year, we are still at 1.4, which is far away from our inflation path pre-pandemic, and of course far away from our aim, which is close to but below 2%. So that's what I really wanted to explain in relation to inflation. That's how we see it, and clearly inflation, our inflation aim and our inflation path pre-pandemic remain two very important anchor of the monetary policy decisions that we will make. Thank you. Oh no, question about climate. So I think that it is almost unanimous within the Governing Council that climate imperatives are nothing less than imperatives. And I have said repeatedly that it is the biggest challenge that is addressed to us. Hence, in my view, any institution, whatever its mandate, whatever its remit, has to question itself and wonder what can be done. Now, obviously, an independent central bank has to deliver on its mandate, and we need to do that, and we need to look at what we can do in compliance and in respect of our mandate without overinterpreting the mandate, using this primary objective, which in my view justifies fully that climate change matters be actually taken into account for various reasons. The integrity of prices on the market, a good risk management, appropriate supervision that falls under the responsibility of Andrea and Ria. But on all those accounts, we have to explore what we can do, how efficient we can be in doing so. And to your very clear question, it will apply, of course, to how we value collaterals. It will apply to how we value corporate bonds, with proper risks being taken into account. Now, at this point in time, the main responsibility, in my view, in the view of the Governing Council, lies first and foremost with governments, and governments at the European level, and Europe is delivering on that respect, but with governments in the various member states. And there will be a staged approach where clearly information, disclosure, investment will all be required in order to address the climate change issue. So while we are, on the same page in many ways with some of the civil society organizations, we cannot help but regretting enormously the approach, the conduct that was adopted, which clearly by paragliding on the roof of the ECB is exposing people's health, life possibly, and we don't think that this is the necessary way to conduct a dialogue. But we will definitely continue this dialogue.
Thank you, Madame Lagarde. And the next question goes to Martin Arnold of the Financial Times. Martin, please.
Hello, Madame Lagarde. Couple of questions for you. Thank you for letting me ask them. Firstly, your colleague Fabio Panetta cited the Daft Punk song "Harder, Faster, Better, Stronger" and calling for the ECB to do more. Do you think that by accelerating the pace of your bond purchases, as you promised to do, that satisfies that call? And secondly, can you tell us whether your latest economic forecasts include the effect of the $1.9 trillion stimulus program that's just being voted through in the US Congress? Thank you very much.
Thank you, Mr. Arnold. Those are two really good questions, actually. First of all, I'm delighted that my colleague Fabio Panetta decided to quote a French group. He could have borrowed from Baron Coubertin, who used some of that as well. And, I go back again to the introductory statement and will be happy to read it again, although you have it in front of you, I'm sure. But when we say the Governing Council expects purchases under the PEP over the next quarter to be conducted at a significantly higher pace than during the first months of this year. And when I tell you that we are moving into action as early as tomorrow, I think that fits the bill. Now, you will find some that will want a little more, a little less, a little this, a little that. Suffice to say that there was consensus at the table of the Governing Council today to do exactly that. Conduct a significantly higher pace of purchases during the first month of this, during the next quarter, as compared with the first 3 months of this year. Now, very good question on the issue of the massive fiscal stimulus that is likely to be signed into law probably today, and will give, knowing Treasury Head Yellen, the efficiency that she has, I'm sure that there will be immediate implementation. The answer to your question is no, because of rules that many of you are familiar with. Until a piece of legislation is voted, we cannot take that into account. So, It was voted yesterday. It will be moving into law tomorrow. Hence, it is not embedded in our provision. But we do, and actually the introductory statement makes reference to the external demand, to the impact that a massive fiscal stimulus will have on our pace of growth, that it will have on trade, of course. So we believe that the Biden plan is actually going to have an impact, not to be overestimated, though, because clearly there will be a lot of domestic measures that will impact predominantly the US domestic markets. But it will have an impact, an external demand that is addressed to the euro area and to other countries, of course, will generate probably and will have an impact on our growth projections. And that will indeed be reflected in 3 months' time when we produce our June provisions. One thing that I will say is that the big difference, if you will, between the Biden stimulus, which, as I said, debated, voted by the two houses, signed into law, checks in the mail, and our massive fiscal stimulus here in Europe, is that there is a bit of a lag time between the two. And the next generation EU, as we say in the introductory statement, is critically important in order to help stimulate the European economies from a fiscal point of view, and is also terribly important for two other reasons. One, because it needs to address the issue of heterogeneity between countries and between sectors, and it needs to focus on what will be productivity enhancing and moving our economies and our Europe into the future with the focus on digital and green. But there is a time lag between the two, let's face it. So while we import a bit of yield increase, the trade movement are going to come, but our own fiscal measures are not kicking in yet. And we need that. We need that. Thank you.
Thank you. And the next question is going to Jan Malin of Handelsblatt. Jan, please.
Madame Lagarde, you had said that you have not taken the Biden stimulus into account, but could you maybe elaborate a bit on how it has already resulted in inflation expectations rising significantly in the US? Could you maybe say something how this will affect the medium term, this global developments affect the medium outlook for inflation in the euro area? And you have kept your inflation projection for 2023 at 1.4%, so very much below the target for the medium term. So why actually didn't you do more from a monetary policy perspective? Thank you.
To the risk of boring all of you, I think that when the Governing Council, by full consensus, decides that purchases under the PEP over the next quarters will be conducted at a significantly higher pace than during the first months of this year, it is not an insignificant commitment that they're making. And I remind you that it comes on the top of the monthly 20 billion euros that are purchased under the APP. So I think that there is a serious taking into consideration of the undesirable yield increase that we are seeing, that we have seen in the last few weeks, portion of which certainly is attributable to the inflation expectations and the GDP growth expectations in the United States. That's to my point of the time lag. I hope we can move fast on the fiscal front here in the euro area. Now, obviously, staff here at the ECB has been very diligent looking at the Biden plan and trying to assess on a very preliminary basis what the impact will be on both growth through the trade channel in particular, and also on the inflation expectations and particularly on the inflation outlook. And there will be some impact. It's pretty clear that will be reflected in future provisions because this has not been taken on board this time around. I think they also want to have a look very carefully at what is eventually delivered after the signing into law of what has been voted yesterday by the House of Representatives. Thank you.
Thank you. And the next question goes to Domenico Conti of the Italian newswire ANSA. Domenico, please.
Hello, thank you very much for this occasion. Madame Lagarde, one question that I have would be about, I know that you've been over the how to preserve financial conditions, just about the purchases that you are intending to make in the coming quarter. Are you targeting a particular segment of the yield curve? I'm asking this in the context of this sharp rise in sovereign yields in the longer part of the curve that we're seeing globally. And if I may, one second question is about the ongoing discussion on setting a European bad bank or a network of national asset management companies. Can you give us a hint of what this discussion is leading to, whether there have been some developments? Thank you very much.
On your first point, the answer is pretty easy. No, we are not focusing on any particular segment of the yield curve. We want to look at the entire yield curve. And while it comes to mind that the 10 years sovereign yield is one that is often referred to, it's not the only one. And we will look at the entire yield curve, which has evolved in a slightly different way, depending on whether you are in these sort of 2 to 5 years or way beyond, including up until 30 years. So we will look at all of it. As I said, it's holistic. I'm not going to take you through that again. I hope it's what we mean by holistic is clear enough. What we mean by multifaceted is clear enough as well. And I know those are not usual words for this particular kind of press conference, but never mind. We can always expand our vocabulary as long as we know what's behind it. So the entire yield curve. On the asset, on the European asset management, the ECB is continuously monitoring the impact of COVID-19 crisis on banks. A large-scale, system-wise increase in NPLs would require a comprehensive approach at the national and EU levels. Now, based on the development and the monitoring, different policy options are being considered and could be further explored. And certainly at the ECB, we have taken note of the Commission proposal to asset management companies that would operate at the national level. And we agree that this is a useful way to manage a systemic NPL problem. As you know, also, my colleague Andrea Enria has had in mind a more pan-European approach. This might come along later, but I think the key urgency is to make sure that there are mechanisms in place that can deal with the risk that bears on banks. Thank you.
Thank you. And the next question goes to Annette Weisbach of CNBC. Annette, please.
Thank you. Thank you very much. Madame Lagarde, I have two questions as well. One would be on the still high euro exchange rate, because clearly, despite all the easing measures, the euro is still very close to that 120 benchmark towards the dollar. How much is that a concern for you and your inflation outlook? And the second question would be more in your capacity as like a global leader. Currently, there's discussion about easing or perhaps changing the Stability and Growth Pact also in response to that unprecedented crisis and the unprecedented debt levels. Would you think that's a good idea?
Okay, on your first question concerning the appreciation of the level of the euro at the moment, I have said that before. I'll repeat it again. We're not targeting any particular exchange rate for the euro, but equally, we monitor very carefully the development of rate, because clearly they have an impact on economic activity and the outlook for price stability in the euro area. It has been quite volatile lately, and we do monitor carefully. I think in the current environment, the ECB will continue to monitor developments in the exchange rate, but we don't focus on the exchange rate as such. We focus on the impact that it has on prices and the implication that it has for the medium-term inflation outlook. Your second question on the Stability and Growth Pact. First of all, I would like to observe that although it's in the remit of the Commission and the Council, the decision to extend or to activate the escape clause, to keep it alive, if you will. I never know whether it's activate or deactivate, but to keep it in place. In other words, escape is allowed, and some of the current constraints under the current SGPs are waived. Their decision to extend it until such time when the European economies are back to pre-COVID-19 is, in our view, the right approach. We are not decision makers in that. We are consulted, and this is certainly the position that we would take. And to the extent that under their winter provisions, the Commission foresee the return to pre-COVID-19 mid-2022, this is actually appropriate in our view to keep that waiver until such time. Our hope is that by the time when the escape clause is deactivated and constraints return, SGPs will have been revisited and will have been improved in order for it to be more simple, more focused on productivity, investment, and also, indeed,